What's going on? How we doing? Zishan, Justin, Paint Bar Trading, German, Ortiz, Bob Means. What's going on? That's because I wasn't talking yet. I wasn't talking. I was jamming. If there's no sound at this point, it's all you. You should have been able to hear the music, though. So apparently, my funded futures, I learned something new today. You pass the eval, they still review the account, the eval account, to make sure that you passed it correctly, which I didn't think that was a thing since they offer the one-day pass, but I guess we'll see how that plays out. Got about 3 minutes here. I'm just looking up one of the Apex rules here for a second. Someone was asking. So not really feeling the open. Just straight sideways. I don't really have a bias on direction. I mean, if anything, I mean, looking at the last 1, 2, 3, 4, 5 trading days, we've just been straight up. So my thought process is we might do what we did yesterday. Fake out to the low side and eventually go up. But the question is it going to happen right at the open? That is the question. Let's see what we're dealing with here. It's not too bad. I feel like they probably fake this out to the downside and then try to move it higher. That would be my guess. What are we thinking about opening trade? That's what I'm talking about. Papa Powell testifying at 10. Yeah, I saw that. May I ask you, what is your Keltner channel settings? This seems to be way bigger than default settings. They are, for a very good reason. I'm using the 13 MA in the middle and 4 standard deviation. Or I always forget. They call it coefficient in Quantower. But it's 4 standard deviations. Well, it's already kind of making the move down. 30 seconds here. Now I feel like they might try to fake this out. Trying higher, see if it's a fake and then they come lower. Give it one shot here. Kind of a crappy open, honestly. They're probably maybe waiting for Powell. Yeah, I'm not doing that today. I'm not gonna let that mess with me. I would have expected it to happen right away. And it's kind of fakey both ways. I don't even think that's 15 ticks. I would have been, my entry would have been like right here anyway. See if it would have worked after it filled us. Nope. I would have had my entry somewhere up here. It looks like we would have got filled on this wick, and now we're playing around with it. There's no way we would have got our 15 ticks yet. I'll show you where my order would have been if it get too far away from it, yeah. I don't want to put it in just yet because we know what happened yesterday. But I will show you. If we start moving down again, I'll show you. There's no way we would have got filled though. My order would have been right here, and yeah, look, that's where we would have been sitting up here somewhere around like 37, 36, 37. So right now, not going long was the right call, because it looks like it's faking out. My stop loss would have obviously been right here, which is pretty far away considering. And it never reached back down to where we would have went short. So we'd still be in this, looking like we might actually would have got bailed out maybe. Yeah. I think we would have been close. I think we were at like 37, like right here. Yep, yeah, we would have got bailed out. And now we wait. What's up, Melo? Good morning, good morning. Trading pre-market, hit daily goal already, back to bed. Let's go. 201 times 10. Let's go, Melo. What did you trade, man? This looks like horrible chop. Just looks like a bunch of nothing all morning. Good stuff though. Good for you. Gary, good morning. So we do still have the other... Whoa, what is going on here? Oh, right, we got the ticks. I was like, what is going on here? Maybe we'll mess around with the futures, or let me make sure I'm on the right one here. We passed number 4, so number 6 is the one that we want to trade, which looks like I already missed the trade. Within the first 15 minutes, I'm not going to trade the open, or the band, sorry. I think the face detect is off on my camera. I need to fix that. So my son was messing with my microphone. Some big candles? Yeah, that was a pretty decent candle. I'm actually surprised. The open was actually kind of crap, and then it was... Because look, here's 930 candle, 931 candle. It was the 932 candle that finally took off. Market only goes up. Looking for the retest of that previous candle there on that push. Pretty strong move. Does not seem to want to give it. Came close there. Ooh, feels like we should get it here. There we go. Ooh, and some. And some. Look at that move back down. Do we want to catch the knife? Let's catch the knife. Why not? Let's have some fun. Ugh. That's dirty. There we go. You never count on that second pop back up. It's always the first one you're looking for. Because if you don't get the first one, you definitely get some continuation. You also have to remember too, I don't get an ad until we get to 1,000, right? So I have to keep that in mind. Yeah, I'm looking, I gotta basically look for perfect entries to start. Back to the high as we go. So where is the scaling? Because I keep typing scaling and it keeps giving me the old chart. I need the new chart. Here it is. So I have to get to 1,000 to get that second contract. Some would say it's probably safer to go to micros and cut everything in half until we get to 1,000. But we'll live on the edge. The morning trade did not work. Our bias was to the short side, and we went straight up, basically. So now we're just trading the our second My Funded Futures eval that we have. No, I didn't blow the account. Oh, the one that's missing? So that's the My Funded Futures that's missing. I passed it, but it's under review to become a funded account. They review the accounts to... I'm not exactly sure what they're looking for. Because I know it says in the evaluation stages there aren't any consistency rules. So that part I don't quite understand. Wow, look at this. Let's go. I like the big candles. Even though they're not in our best interest for where they're at. I like that we're getting the big candles. Yeah, I'm a little confused on why it says they're going to review it, but that's what the email said. Here it says, "Hi Tim, congratulations, you've passed your eval with My Funded Futures, account ID, yada yada yada. You will receive an email when your funded account is ready. Please allow up to 24 to 48 hours during weekdays for staff to properly review your account." So I don't know what that means. I mean, it seems just like a standard message that they send out, but it is what it, I mean, that is what it is. Nothing I can do about it. I think it might just be part of the process for them. Yeah, as Pine Tree said. I mean, it sounds like I said, it sounds like a pretty standard message they send out, so. Please send your banking and social security info. Fully complete the review. We go back down to retest the pre-market range. It does look like that's what's attempting to happen. Coming up on that 15 minutes. I was really hoping this this big candle down went a little further. I was looking for it to get down here into the near 700. I would have definitely got in. Look at the bands. Look how far away they are at the moment. Dun, 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 dun. Apex still pending. There was a guy in the Discord that got approved and it's in his bank account already. So I think it's just, I don't know what their process is, but for some people, it just seems to take longer than others, but you'll be fine. You just gotta wait your turn. Yeah, the one guy, it was for 6K. He posted it. It's Gary D. Yeah, it's already in his account. It's a coming. Yo. Steve's just a little jealous. Steve's a little jealousy boo. By the way, for anyone interested, Bulenox 90% off ends today. So if you're looking to add any 90% off accounts, Bulenox is very much like Apex. That ends today. Code VOLA at discount. Sorry, had a little burpee there. Apex also ends today. Theirs is a little bit different. If you want a 150K, so a 50K, a 150K, a 250K, or a 300K, they are all $40. Well, 36, whatever it is. With code VOLA, you get that discount. Now, today's the last day to get that. However, you have until August 15th to pass the 150K, the 250K, and the 300K, and you only have to pay an $85 lifetime activation fee. So if you pass those evaluation accounts that you can get today, is the last day to get the 80% off on the 50K, or any of the accounts, you get 80% off. But for the 150K, 250K, 300K, you can get them for the same price as the 50K at 80% off. So it's like 36.80 or something like that. I don't know. I haven't bought one this time around, so I don't know the exact number. But you have until August 15th to pass those evals. So it's no rush, but today's the last day you can purchase them. So until August 15th, as long as you pass them by then, for $85, you can activate those when you do pass them for $85 as a lifetime activation, not just monthly. So that's a pretty awesome deal if you can pass them. I have trouble passing those evals, so I've just kind of stayed away from them. And I told myself I wasn't going to buy any more unless I got to pay out. And we're super close. If we pass this 19, if we find a trade from here until the end of the day, I'll probably grab one 150K eval and try to take our time passing that and see if we can't pass it. The My Fund of Futures, we passed that one. The one that's still active, the one that you can see on the screen, is the new 50K starter. The new one that's $76 a month when you first sign up using my code VOLA as always. And then if for some reason I were to fail, I can then reset it for 50 bucks, which is actually 48 bucks. You know what? Let me do the math. I keep saying that, but I want to make sure. Yeah, it's actually 47.50. So it's not even 48. So 47.50 to sign or reset that. And it's only per month if you don't pass it in the first month, like during the eval stage. Once the eval stage is over, that's it. That's all you pay. The upfront amount that you pay is all that you pay. So if you pay that 76 bucks, you pass. Once you pass, that's it. Like, you have a lifetime 50K account with them. There's no additional fees, nothing. It's literally the best account out there right now. The only sucky part about My Fund of Futures is you can only have 3 of them. So if you're the kind of people that like to have 20 accounts, My Fund of Futures, you're shit out of luck with that because they only have 3. Bulenox, on the other hand, you start with 3, but you can scale up to, I think, 13. It's either 11 or 13. I want to say 13. But yeah, if you have any questions, those are the 3 firms I'm sticking with for now. I am going to grab at least one Bulenox account. Actually, I might just do that now. I only want 500. When you play your opening trade, I know your profit target is 15 ticks, but what's your stop loss? No more than 4x that. So 60 ticks. I usually have, so like this morning, if we go back, so like my entry was right below this candle. So if we do 60 ticks is all the way up here, 736.50. So like right there. So I had plenty of room to the upside if I needed to stop out 4x, but I would never plan. I'm usually using the top of that candle as my stop, which I don't remember if this candle was already, this is the 930 candle. So I don't know if it's got to the top, or yeah, because it went up first and then started to come down. So I would have been using the top of that candle. So it would have been a little bit less than 4x. I'm always, so if you were around when I was doing the bracket orders, wherever I would put my entry going the other way is where I'm going to put my stop for the other way, if that makes sense. I feel like that should make sense. So like if I'm putting, if my idea was to put an entry here to go short and an entry here to go long, my stop for going short is going to be where my entry would be to go long, right? Because if it's going to be a long at that point, I don't want to still be short. And if I'm long and it starts to go down to where I would get short, I don't still want to be long, right? So it kind of takes care of itself, which is how it always should have been in the past anyway. Wherever my entry to go one way should be my stop from the other direction. I mean, it makes the most sense. Yeah, I don't know how to put quotes in there, Gary, but I do need to put some in there. Why don't you buy 2 and play news both ways? One win, one lose. Other words, I mean, you could. Some people do that. I like to try to not waste any money. I'm frugal. I try to just always pass them. I know my face, if I lean a little too far this way, it picks up the fish tank for that split second, which is annoying, obviously. Obviously. Let me check my options super quick. Looks like they didn't do good at first, but now they are. GME getting ever so close to 25 again. Here's where we're at. So looks like these are all going to expire worthless. They're good until the 19th. If I do roll GME, I'm probably going to try to stay at the 19th because I like to keep these where they are, if at all possible. CCL is actually going back up today. If CCL would have kept going down, I probably would have tried to roll that back to that same July 19th. But it kept climbing on me, so I had to keep rolling it, which is fine. PayPal, where are we at with PayPal? It's starting to come back down. Does that expire this week? Or next week? Yeah, it does. Oops. So, everything's looking pretty good. I mean, these are going to expire worthless. JD and Oxy. So JD at 35. Obviously, we're nowhere near that. That thing took like a nosedive. Oxy at 70. Also nowhere near that. So those are safe. They're going to expire worthless. Hood at 30. Also really nowhere near that. I remember when I got that, I was surprised at how much they were paying for it, considering we never even got above 25, but I'll take it. I don't even remember. What was it? Was it because of earnings? I think it was. Yeah, I got $55 for that, which was pretty insane, considering it never even went above 25. I was pretty happy when I got that. But yeah, I think that was because of earnings. But all right, back to futures. Hi, just one question. Did you buy or sell them options? Bought? Yes. So real quick, I'll go back. The only options I bought are the ones that say calls down here. These are leap options. If you look at the expiration on them, like this one's September 18th of 2026, June 18th, 2026, June 18th, 2026, January 16th, 2026, January 16th, 2026, January 16th, 2026, January 16th, 2026. So those are leap options. Long-term expiration, something. I don't remember exactly what it means. It just means a long-term call option, essentially. Long-term. I honestly don't remember what it means. I'd have to, let's see. Leap option meaning. Long-term equity anticipation securities. There you go. But what I do is I do that and then I sell covered calls based off of those positions. Now, Carnival, I have 100 shares of, where is it? Right here. Carnival, I have 100 shares, and GME, I have 100 shares. But I don't want to hold on to GME forever. I'm honestly, like, I keep going back and forth. Like, I would be perfectly fine with this finishing at like $25 and like 10 cents. Like, that would be perfect on Friday, right? Because then I lose out on what, 10 bucks, but I ended up making a pretty decent amount. Or I could continue to roll to hold the shares and lower my overall average, but then I'm risking actually holding GME, which we all know what GME can do. But right now my break even is like right under this 2250 area, which is what it's trying to use as its main support. So my theory would be is if for some reason we can't ramp back up and go crazy, that I just jump out here and I would essentially break even overall in the trade. But I'd rather just take my win. The only thing that would suck is like, say my shares get called away at 25 this Friday, and then the thing like goes to 70 again. Like, that would suck. But I'm never gonna make it up to that far if it happens all in one day, because I can't roll that far that quick on something that happens that quick. It's just not possible. So I would be stuck anyway at like 26 or whatever I roll to, or like before the price takes off. So I mean, that is what it is. Now my other option is I could just, as Friday comes along, like say we're going back down to like say 24, I could just sell the option or buy the option back for probably, it'll almost be worthless at that point if it were going back down, and then just sell the shares. So I could technically still make money if we're not still heading in the right direction. Now, some people would say best case scenario, regardless of the stock, is like, say this finished at like 24.90, right? Then my covered call expires worthless. So this $70 that's sitting there would go into my account, which it's going to regardless, because even if the shares get called away, like eventually that's going to be zero, whether it's through my shares or whether it just comes down and expires worthless. But if we were to close at 24.90 on Friday, this would expire worthless, and I get to keep my shares, and I get to keep the premium from selling this call. All right, let's go back over to here. We're getting quite a move up here. Switch over to Apex. Let's get the bands bot running. Make sure it's working. I'm not on the right account. So make sure we're ready to go just in case. All right, there we go. Start marbles. I need to figure out a way to add the quotes. But yes, I focus on selling options. I do not buy options unless they're like the long-term leap options. And the only reason I'm doing that is because it's a cheaper way to own the stock. Instead of just buying 100 shares, you can buy a leap option for much cheaper. Running a 3 GME covered weekly. Did you also sell uncovered calls? No, I don't do that. Or did the long expiration outdated calls cover the sold ones? I'm not exactly sure what you're asking. If you're talking like degen style, then no, that's not me. I'm always covered. Whether it's a cash secured put, whether it's a covered call, like I'm always covered. I'm never going Rambo. I'm collecting the premium. I'm not paying the premium. I'm the one that's always on the other side of... I'm the one that's on the other side of everything. So we need 150 bucks. Ugh. Which would be 30 ticks. See what that looks like. Yeah, so we'd still need a pretty decent push. I feel like everyone's waiting for 10 o'clock, which is in 1 minute. So, by the way, Powell is about to start talking in 1 minute and 10 seconds. Well, I don't know if he's actually going to be talking specifically at 10, but I know that his talks start, so be ready for some volatility. Yeah, ideally I want the GME on Friday to end at like 25.05 because I would like to make the max that I can, but at the same time, I've never went through the process of my shares getting called away. So it would be nice to gain that experience. I've never done it before. So since I started selling options, I've made $1,446.76 in premium. Not once have I been assigned, whether it be a cash secured put or a covered call. Not once. All right, 10 o'clock. See if Powell's got anything fun to say. Would he be on like CNN? I guess I could pull that up. Watch. This is not live. Oh, it's going a little crazy. Anchorman, the legend of Ron Burgundy turns 20. That's what they're talking about on CNN. Where can I watch Fed Powell talk? Fed Powell Speech today. Watch live. The Fed live video. It's on YouTube. Okay, here we go. And so he's not even out there yet.
And it's awesome to have someone.
Let me know if that's too loud.
Because part of what I was going to say was just covered. So now I get to present like a shorter, more abbreviated version. So thank you. But the first part I want to talk about is obviously a huge friction point for financial inclusion is credit access. And so credit can be a gift or a curse, and that's debatable. But what's not really debatable is the fact that it's a necessity for most people. Whether we're purchasing homes, cars, or food, most Americans depend on credit, not just to build wealth or for luxuries, but for basic daily needs. And so I'd be remiss to say that there's a worthwhile discussion to have about our credit dependence, and it's not within the scope of this particular program, but more ambitious cures to that might be higher wages or expanding the social safety net.
If you heard this girl's voice, what would you think she looks like? Describe to me in chat what you think she looks like, and then I'll show you what she looks like.
Banks. One question I often ask, or usually ask myself, is how can we make safe credit broadly accessible to all those who need it in light of our current economic reality? And so my research identifies, or at least tries to categorize some of the innovations into two broad approaches. One is to evade the credit markets or to expand the credit markets.
You guys are going two very different directions.
Taking either approach with some of the innovations. And the first is earned wage access programs. And so in this project, I had looked at earned wage access programs, which aim to evade the traditional credit market system by offering
all right, let me set this up.
Or any term other than loans, but
all right, here she is.
offering funds in advance of a user's payday based on the fact that
I bet none of you expected her to look like that. Taller than Zishan. Like, I wouldn't say she's fat. I wouldn't say she's like ugly. She's definitely not 800 pounds. If I close my eyes and hear her talking, I would not expect her to look like this. Am I watching the right thing? Is Charlie actually relaying what Fed Powell is saying? I mean, this is from the Fed's website and it's live. I'm assuming this is the right thing to be watching. Weekly covered calls for Tesla this week. Do you own 100 Tesla shares? I'm always for selling covered calls, no matter what it is, as long as it makes sense. I'm mad that I don't have Tesla stock at $150. I'm such an idiot. Wonder what trading with Travis looks like. That's true. So we're very good in my Discord at guessing what people look like based off of the sound of their voice. And when I hear Trading with Travis talk, I have a very distinct idea of what he said, like what he looks like. I don't know. If this girl was wearing a bowling shirt, I'd probably be down. Okay. You own 100 Teslas? Whoa. All right. I don't think I'm watching the right thing.
To the extent they need their funds.
I don't think I'm watching the right thing.
So if it's subsidized or covered by an employer, that is now the employer bearing the cost of holding the workers' funds. And then also the employer is better positioned to negotiate better.
Yeah, I wasn't watching the right thing. Listen to this guy. Can you guys hear him? Oh, hold on. Hold on.
This price cap on life-saving drugs for all Americans. And why my colleagues and I on this committee are working, it's why we're working to lower housing costs for more Americans. The Fed also continues its work to keep the banking system stable and ensure consumers' money is safe. Last year, the Fed and other bank regulators issued a proposal to update bank capital requirements, strong capital standards, and you've heard in this committee overwhelming support for strong capital standards.
What if Powell just comes out and pulls a Fauci, and it's just like, yeah, I've been lying about everything this whole time.
Which they often do. Investors, executives, and shareholders should pay for it, not taxpayers. The biggest banks have spent obscene amounts of money attacking this Fed proposal. But you, the Fed, don't work for big banks. You work for the American people. Your concern should be developing capital rules that protect Americans' money, not protect bank CEOs' stock portfolios. The Fed needs to look past these shameless lobbying efforts and finalize a rule in the best interest of taxpayers. Another dangerous piece of
I'm sorry, I had to check something real quick.
Makes our banking system less safe is incentive-based compensation. This compensation model rewards risky behavior that enriches Wall Street executives in the short term, but makes banks more likely to fail. We saw the results of that model in 2008. We saw it again last year with the failure of Silicon Valley Bank and Signature. Other regulators have moved forward with a proposal to rein in these reckless incentives, but the rule, Mr. Chair, can't move forward without your and the Fed's moving on it. This rule is long overdue. The Fed must join this statutorily required effort as soon as possible. The Fed also has the important job of reviewing mergers and acquisitions between and among banks. Over the last several decades, we've seen the largest banks grow into massive, literally trillion-dollar companies, while thousands of small banks in rural communities in Northwest and Southeast Ohio, in small towns in those communities, in those areas, and all across America have disappeared. Consumers have lost trusted local banks. Small businesses have lost long-time reliable banking partners. Regulators like the Fed have the crucial job of guarding against mergers that reduce or eliminate competition and lead to bank closures or layoffs. I recently sent comment letters to the OCC and the FDIC on their current efforts. I expect the Fed to take the proper steps to ensure that its merger review process is robust and that it protects consumers and communities. Finally, Mr. Chair, you must ensure the Fed has high ethical standards. Fed officials should never again be able to profit from their positions by using confidential plans about Fed monetary policy and emergency programs to pad their investment portfolios. The board's latest update to its trading rules is simply not good enough. It still fails to establish the clear penalties needed for Federal Reserve officials who make investments in violation of the public trust. A rule with no consequences is really not much of a rule at all. The American people need to be able to trust that the Federal Reserve works for them in a time of deep cynicism that people have about the federal government overall. The American people need to know that officials aren't abusing their positions for personal gain. As chair, you have an important role to play to make sure the economy works for everyone, not just for Wall Street. The Fed's regional banks must do their part to hear from people and other stakeholders in their 12 districts to understand their needs. I look forward to hearing today how the Fed will balance its dual mandate, how it will protect Americans' money, how it will foster an economy that upholds the dignity of work. Senator Scott.
Thank you, Mr. Chairman. Thank you, Chairman. Joe Biden broke this economy, and it's been very difficult to fix it. That's the bottom line. I want to start with the end in mind. Joe Biden broke our economy, and it is very difficult for anyone to fix it. Everyday families are struggling to put food on the table.
Pause the music for this.
Being eaten away by rising prices.
Wow, the market likes this guy.
Inflation. Think about the fact that for 52 consecutive weeks in the Joe Biden,
It's a good question.
wages were eclipsed by inflation for 52 consecutive
He-
paychecks. I remember back in December 2020, in South Carolina, gas was $1.99 per gallon. Today, it's still $3.19 per gallon. A 50%
It says 190,000 a year.
years. So it's devastating to the average American family, particularly families like the one I grew up in, a single parent household mired in poverty. When you see your gas prices up 50%, your food up 30%, your cost of keeping
Market's
your house
moving up
cool
on
or
this. Just made new
warm
highs.
up 25%. It's not a challenge. It's
And
not
it says 190.
It's an absolute.
I mean, obviously it comes with the
crisis.
power of the
Too many
position.
households in
They make
America
more.
today
I mean, it's been known for a while that they make more
and they fear
outside of the job.
challenges that are coming our way, the headwinds brought to us by the Biden administration. Those headwinds, of course, are seen through the prism of inflation. Inflation hasn't been this high since the Jimmy Carter years, and that devastation is being felt and measured in households by too much month at the end of the money. And that devastation is real for the vast majority of Americans. And the pointing finger, I tell you what, whether it's the Biden administration throwing the Fed under the bus or any other way they can deflect from the real problem. I've seen it, committee hearing after committee hearing after committee hearing. My friends on the left want to point their fingers at anyone other than the real culprits at 1600 Pennsylvania Avenue. The progressive wish list, spending projects, and out-of-control regulations of this administration continues to eat away at American paychecks. And they continue to blame, whether it's shrinkflation, greedflation, skipflation. They're looking for someone to blame except for Bidenflation. The devastation of Joe Biden's economic policy continues to impact everyday Americans. The American people see through the facades and they want real solutions. It doesn't take a PhD economist to understand what the average American is experiencing under this administration. When President Biden and my Democratic colleagues pump trillions of dollars into our economy, those dollars increase the demand and pushes prices higher. It's that simple. The American people see and feel it every single time. And they see it, as I said earlier, the grocery stores, the gas stations, at the doctor's office. It's just undeniable the impact that this is happening. Just last week, we celebrated the birth of our country, the birth of this notion of freedom and liberty. But American families got slapped with the most expensive July 4th on record, with a cookout this year costing, on average, 30% more than it did just a few years ago. I call that hogwash. What's worse is that this administration
This guy's punny.
doesn't want to learn a lesson in economics. Instead of reducing the push for more spending and more regulation, they only simply double down. Let's take, for example, the tens of billions of dollars of student loan forgiveness. Constant new plans to forgive more money, regardless of the constitutionality of their decisions. So it's important to ask, who are these billions of dollars of forgiveness actually benefiting? Well, the answer is simple. This forgiveness scheme will result in debt relief for 750,000 individuals from households with an average income of 300,000 or more. And just don't forget the fact that the average American family has a household income around $74,000. So what we're doing with this unconstitutional student loan forgiveness is actually asking the median household of $74,000 per household to bear the burden.
What do you mean, listen,
forgiving debt
brother?
For students who live in households of over $300,000. And the actual cost of this, somewhere between 870 and 1 billion and 1.4 trillion dollars. So why do I have to even ask the question? Why do we continue to punish American families struggling paycheck to paycheck with a new scheme to relieve households over $300,000 of student loan debt? Well, the answer is pretty simple. Politics. It's one way to buy vote after vote after vote for November's election.
It's exactly.
It's just hard to imagine.
I mean, it's so funny hearing Congress say the
words
exact same
outlined
shit I've been
in
saying for
inflation.
months.
I think it's past time we all recognize what
Maybe I
is
should run
truly
for Congress.
political pandering.
It's so funny
from the left.
because
I strongly believe that our economy
guys like this
cannot
guy
handle any more of this wasteful
are
spending.
just constantly hearing it from people like me that actually
But it's not
call
just spending
people like
policies
him.
that stifle growth,
And he's
it's
literally just the
also
messenger.
overregulation. And I can't
I mean,
think of a
obviously they
better
have to
example
believe
of
what you're saying, but
overregulation than parking more capital on the sidelines through Basel III.
I love how Powell's just like, I
Proposal
don't care.
itself
He's just like, I don't care.
cost millions of Americans.
He just
their
has that
chance
look on
to
his face.
Own a home, start a small business, and have access to the credit and the capital necessary to make their American dreams come true. For those who are actually watching this hearing today on C-SPAN, Basel III capital requirements are like taking your star quarterback, Dak Prescott, and telling him to sit on the sidelines because he just might get injured during the season. It's just plain ridiculous. But these proposed
actually a good
capital
analogy.
requirements would just do that, forcing more money to the sidelines of the greatest economy on the planet and out of the hands of first-time home buyers, business owners,
Steve,
and folks trying
Jesus.
to achieve the American dream. The stakes are high, and that is why we have to get this right. You've heard me say this a number of times, but it bears repeating. We need transparency in your rulemaking process, as this enormous proposal lacks any form of clear justification. Chairman Powell, it is essential that you and your fellow governors and the other agencies join in this rulemaking, follow the law, do the homework, and then let the public check the work. And that's why I believe that it is absolutely necessary to have a complete re-proposal of Basel III Endgame. Give the stakeholders an opportunity.
Check this thing out
to
that
take a look at
Froggo
and
posted
recalibrate what
the other
is
day
necessary
in
going
the
forward.
Discord.
Any increases in capital that are not quantitatively justified harm the American people who need.
The White House. We're unable to track $6.2 billion that was sent to Ukraine. California. We're unable to track $24 billion spent to combat homelessness. The Pentagon. We're unable to track $2.3 trillion of military spending. The U.S. Treasury. We're unable to track $5 trillion of pandemic spending. The IRS. We know you sent $601.57 to your friend. You better report that or you're going to jail.
Thanks, Senator Scott. Mr. Chair, welcome. Thank you for your service and for your testimony today. Please proceed.
Chairman Brown, Ranking Member Scott, and other members of the committee, I appreciate
There we
the
go.
opportunity to present the Federal Reserve's
Watch the markets.
semi-annual monetary policy report.
That sounded like a bitching
Federal
session,
Reserve
not a
is
monetary
squarely
report.
focused on our dual mandate to promote maximum employment and stable prices for the benefit of the American people. Over the past 2 years, the economy has made considerable progress toward the Fed's 2% inflation goal, and labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that the U.S. economy continues to expand at a solid pace. Gross domestic product growth appears to have moderated in the first half of this year, following impressive strength in the second half of last year. Private domestic demand remains robust, however, with slower but still solid increases in consumer spending. We have also seen moderate growth in capital spending and a pickup in residential
Louder, you still can't hear
investment
it?
so far this year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, a broad set of indicators suggests that conditions have returned to about where they stood on the eve of the pandemic, strong but not overheated. The unemployment rate has moved higher, but was still at a low level of 4.1% in June. Payroll gains averaged 222,000 per month in the first half of the year. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers.
It didn't matter what those people said to him. He was just going to say exactly what's on his piece of paper, regardless. It didn't matter.
Workers in their prime working years, and a strong pace of immigration. As a result, the jobs to workers gap is well down from its peak and now stands just a bit above its 2019 pre-pandemic level. Nominal wage growth has eased over the past year. The strong labor market has helped narrow long-standing disparities in employment and earnings.
I think this was just what he was going to say regardless.
Inflation has eased notably over the past couple of years, but remains above the Federal Open Market Committee's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.6% over the 12 months ending in May. Core PCE prices,
Whatever he's saying, the market doesn't like it.
Energy categories also increased 2.6%. After a lack of progress toward our 2% inflation objective in the early part of this year, the most recent monthly readings have shown modest further progress. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee has maintained the target range for the federal funds rate at 5.25% to 5.5% since last July, after having tightened the stance of monetary policy significantly over the previous year and a half. We've also continued to reduce our securities holdings. At our May meeting, we decided to slow the pace of balance sheet runoff starting in June, consistent with the plans released previously. A restrictive monetary policy stance is helping to bring demand and supply conditions into better balance and to put downward pressure on inflation. The committee has stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. Incoming data for the first quarter of this year did not support such greater confidence. The most recent inflation readings, however, have shown some modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting.
Okay,
We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation. At the same time, in light of the progress we've made both in lowering inflation and in cooling the labor market over the past 2 years, elevated inflation is not the only risk we face. Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering adjustments to the target range for the federal funds rate, the committee will continue its practice of carefully assessing incoming data and their implications for the evolving outlook, the balance of risks, and the appropriate path of monetary policy. Congress has entrusted the Federal Reserve with operational independence that is needed to take a longer-term perspective in the pursuit of our dual mandate of maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on those goals matters to all Americans. I'll conclude by emphasizing that we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. Thank you. I look forward to your questions.
Thank you, Mr. Chair. And the senior member of the committee will begin the questioning. Senator Reid.
All right, I think this is where we get the good stuff.
Former President Trump.
Oh, we're gonna hit the bins.
indicated that he would propose
I just don't know if I want to trade
a
this.
substantial increase in tariffs of between 10 and 60%.
I'll bounce right off. I didn't hear the alert
By
though.
doing those,
We didn't get an alert.
eliminate the federal income tax.
It was right there though.
First, on the question of what would be the impact of tariff increases on prices, consumers, and the economy?
Thank you, Senator Reid. So I'm going to say that we go very far out of our way not to comment on campaign-type information. We just don't do that. We also don't comment on trade policy. We have really specific and important jobs, and we try to stick to those.
Well, I'm glad I allowed you to establish that principle up front, Mr. Chairman. But let me opine a bit. 10% increases in tariffs is going to have an effect on prices in the shop aisle. It's going to increase them because they'll be passed on likely. 60% tariff increases are significant. And in fact, I've been told that to replace the income tax, you would have to raise tariffs across the board 70%.
Looks like it would have worked if you took it.
For the loss of the income
I just don't know if I want to trade
would,
this.
I think, create huge.
I mean, it's basically news.
I respect your impartiality and your neutrality, but the numbers don't seem to add up to anything that would help the country. Let me switch to something else that might be more within your line of response. You said in your opening statement that labor markets appear to be in a better balance. And that's one of the key factors to
Definitely would have worked.
judge whether interest rates can be raised.
See what 31 ticks, even based off where it hit. Oh, geez, yeah, plenty.
We're not on a very faster track to decreasing interest rates from the Fed. And because of the better balance you cite. Could you comment on that, Mr. Chairman?
Sure. So the most recent labor market data do send, to your point, a pretty clear signal that labor market conditions have cooled considerably compared to where they were 2 years ago. This is no longer an overheated economy. This is an economy, as I mentioned in my opening remarks, that is more or less back by most measures to where it was before the pandemic. And that was a strong labor market, but it was not an overheated labor market. So I think the upshot of that really is that we're well aware that we now face two-sided risks and have for some time. But now, the labor market appears to be fully back in balance. We know that if we move too quickly, we risk unnecessarily hampering economic activity and possibly interfering with the ongoing expansion. We know that if we move too slowly, that we may undo the good we've done. Well, actually, it's the other way. If we loosen policy too late or too little, we could hurt economic activity.
Good old
If we
Apex.
loosen policy too much or too soon, then we could undermine the progress on inflation. So we're very
I guess I
much
could trade the eval.
balancing those two risks.
think about
and
that.
That's really the essence of what we're thinking about these days.
But the direction seems to be going towards lowering interest rates at some point. We would hope that might be a wish rather than a direction.
But I think if you look at the last summary of economic projections, I guess I would say it this way. It doesn't seem likely that the next policy move would be a rate increase. We don't take things like that off the table, but that does not seem the likely direction. The likely direction does seem to be as we make more progress in inflation and as the labor market remains strong, we begin to loosen policy at the right moment.
Thank you.
Apex
2
just came
weeks
back
ago,
up.
The Supreme Court handed down 2 decisions that impact every federal regulatory agency, including the Federal Reserve. They overturned the Chevron case, which had eliminated judicial deference to agency decision-making.
There we go, right on the day here.
Many decades. And they also dramatically extended the statute of limitations under the Administrative Procedure Act. What is your judgment is the cumulative effect of these decisions on the Federal Reserve? More broadly, what does it mean to the economy if virtually any regulatory decision the Fed makes can be second-guessed by a judge? What position are we in now?
So we're as an institution very focused on
that TV in front of him, he sees himself because it's just showing what they're seeing, what we're seeing.
Value that we have.
So he's just sitting there staring at himself.
Those are brand new decisions that just came down, and we're really in the process of just studying some. I don't have anything for you on them, but we will, of course, follow the law as the Supreme Court. As the Supreme Court has read it, because that's their job.
Well, thank you, and I concur with compliance with the law, but when you do your analysis, and if it is detrimental to your ability to regulate the banking industry in the United States, I think you have an obligation to make that public. Thank you, Mr. Chairman.
Thank you, Senator Reid. Senator Scott from South Carolina is recognized.
Thank you, Mr. Chairman. Chair Powell, we've heard a steady stream of commentary that there will be changes to Basel III endgame proposal. That can be seen certainly as good news. Some reports say it could be finalized as soon as August. Others say you are circulating a term sheet for a revised proposal. Through it all, this proposal will have outsized impacts on our banking system, from big to regional to our U.S.-based foreign institutions, as well as impeding access to credit for consumers. So even though you yourself have said there will be broad and material changes, I believe this proposal is flawed, both in process and in substance, and should be withdrawn. Do you agree, and will you commit to withdrawing the existing proposal and issuing a new proposal with a robust notice and comment process?
Well, let me update everyone on the status of all that. So over the past several months, we've had, in fact, Vice Chair for Supervision Barr has held a series of discussions with the other bank regulatory agencies around potential changes to the original proposal. I'm pleased to say that we've made quite a bit of progress on those and are very close to agreeing on the substance of those changes. And I can't really be specific because nothing is agreed until everything's agreed, so I won't have a lot of specifics for you today. The question where we're continuing to try to make progress is that of process. So it is my view, it is the strongly held view of members of the board that we do need to put a revised proposal out for comment for some period. And the reason is, when there are broad and material changes.
Where do you have the account with the 76 USC? It's my funded futures.
Consistent with past practice and with
it's the 50K starter account.
So that's very much what we think, and we're working through.
It's $80, but 76 if you use code VOLA.
Question with the FDIC and the
consistency rule with Apex based on per trade or day.
I'm very hopeful that we will.
It's based on the day.
We're prepared to move forward when we do reach agreement on that.
Well, I appreciate most of your response there. I do want to discuss one aspect more of Basel before we move on to another topic. I find it very concerning with how much of this proposal, this process, appears to have been done behind closed doors. The Fed, the FDIC, OCC proposed Basel III endgame last July. Then in October, the Fed began the collection of data to conduct a quantitative impact study on the cost of Basel III proposal, a study which I will note should have been conducted before any proposal was ever issued. Move forward to January of this year, Vice Chair Barr committed to a public comment period once results of the study were published. We are still waiting to view the results. Keep in mind, all the while, we're hearing rumors that the Fed is working on revising its proposal and moving towards an updated version. Please help me understand, how will the Fed revise or reissue a capital proposal before receiving public comments? Basically my question.
Well, as you know, we have received extensive public comments, and we've also evaluated the quantitative impact survey that you mentioned.
Yes.
And so the idea would be when we do reach agreement with the other agencies fully, that we would publish the proposed changes and also the
probably could have held on to that a little bit longer, but
also the effects that the QIS.
I was looking left. It's kind of where all that support was.
So we'll put all that out for comment.
Didn't want to fight it
for a period of time, and then having had yet another round of comment, and we can then move toward finalizing. That's basically the broad strokes of how I would see this moving forward.
And how long do you see that opportunity for?
Marius, what happened?
So it would be meaningful. I mean, it might be 60 days. We don't need to it doesn't need to be a long one. But, before we do that, there's a lot of work that needs to take place, before you actually put out the revised proposal, quite a bit of work. So it will take some time. And
Yeah,
then we would
doing my
put it
best not
out,
to trade the news.
and then there would be, let's say,
Five, yeah,
just taking
five
that number,
contracts on
60
news.
days per
That
comment,
can definitely
and then we
get
would
you.
get the comments
I'm sorry,
back,
man.
and there would be another period of evaluating the comments, and only then would you go final. So there are a number of steps here.
Yeah, thank you. Well, just final point as I'm running out of time here. I think Senator Reid made the comment about the Chevron case and the impact that it could have, certainly curtailing, from my perspective, the regulatory state. The necessity of a cost-benefit analysis on new regulations that will impact the economy, I think, is quite helpful.
Yeah, I figured it out.
1,000+ pages of Basel III. I think there were about 20 pages that reflected some kind of cost-benefit analysis approach. I really hope that we see more of that going forward.
You were that close. You're scaring me because
Senator Tester from Montana's right.
I'm literally at 52,459. One less than that.
Today, appreciate your work. Look, regardless of where I go in the state of Montana, housing is a big issue, whether it's Billings or Butte or Bozeman or Busby or Big Sandy, it doesn't matter. Larger towns to medium-sized towns to small towns, housing is a huge issue. And I think it's a huge issue all over the country, and correct me if I'm not correct in that. And I was wondering how the housing challenges fit into the overall economic picture that you're seeing.
So we do pay a lot of attention, and I would agree with you. We have significant housing issues in the country, and we had them before.
That sucks, Marius. That would have almost got you back to even, huh?
The pandemic has created new distortions, and monetary policy works through interest-sensitive spending. There is no more interest-sensitive spending than buying a house and having a mortgage. So, for sure, our tighter policy is having an effect on economic activity in the housing sector. But I would also say the best thing we can do for housing is to succeed in getting inflation down to 2% on a sustainable basis, so that rates can come down, so that the housing market can get back to what was the pre-pandemic normal, which is to say still a housing shortage, but not dealing with the kinds of specific things we're dealing with now.
So let me drill down a little bit. I'm speaking not necessarily from a housing cost interest, and you're correct on the things you just brought up. I'm speaking more from a standpoint of economic growth, in that there are plenty of small businesses, schools, hospitals, Main Street businesses that can't hire people, they can't expand because there simply is no place for them to live. How does that fit into your economic outlook metrics? Because I think it's, from my perspective at least, I think it's limiting the opportunity for expansion. It's limiting the opportunity for entrepreneurs, business startups. And does that fit into the economic picture that you look at?
So our mandate is for stable prices and maximum employment. And again, I think for housing supply, the best thing we can do is get inflation under control so that rates can come back down, so that we can have a more normalized set of rates and a more normalized housing system. But
you will. Persistence.
Policies to increase housing supply.
Yeah, I was going to say, I do think 5 contracts is a bit much.
They're in the hands of legislatures, state and federal.
Do you believe that if we were to put forth some housing incentives, whatever they may be, that could have if those incentives resulted in more affordable workforce housing on the market, that would have positive impacts on the economy?
These are questions for you, but I would say this, that I'm aware that housing is in short supply, and that for many it's a critical need for the workforce. Okay. And so more of it is better. But as to where the fiscal policy how you should prioritize that, that's not up to us.
Look, I want to talk about the independence of the Fed for a second, because I know that you are a strong supporter of independence, as am I, and political influence, I don't think, helps with monetary policy in the country. And so give me your perspective, at least, on why the central bank independence is so critically important.
Thank you. I'd be glad to. So essentially all advanced economies have adopted a policy of central bank and operational independence, and that just means that we make our decisions. We're instructed to make them without taking in extraneous factors, one of which would be politics. And the record is pretty clear that that's a good it's a good institutional arrangement that serves the public well. And we just want to stress, as we do periodically, that this is an institutional choice that we make as a country, and that as long as it's seen to serve the public well, it's a good choice. We think so.
Okay, on advanced economies, there's some that talk about the economy of this country not being in very good shape. From your perspective, tell me how the economy of this country is doing compared to other advanced economies that have central banks.
So I'm in lots and lots of international discussions.
He has plenty of hair, Rayu, because he doesn't have to worry about money.
Just how exceptional
it's so funny. We listen to these people talk about our problems as U.S. citizens when they don't have any of these problems, because they're the ones benefiting from us paying all this money. They're all being paid by our taxes, every single one of them. And then on top of that, they're getting this insider information, et cetera, to where they can take that money that we're paying them to make more money, and we have no rights to any of that.
The answer would be no.
It's such a corrupt system at this point. It's ridiculous.
South Dakota's recognized.
Thank you, Mr. Chairman.
All these people up here asking him the tough questions, they might believe the questions that they're asking, but it's really almost just to save face, to make it look like they disagree with what's actually happening. But they could care less, because they're not in the trouble that we're in. None of them are middle class. None of them are poor. None of it. It's bullshit.
But let me just ask a specific question, and you can kind of pick it apart.
Exactly, Froggo. Like, they don't, when they go out to eat every single night, they don't look at the bill. They don't have to.
Every risk type outlined.
It's just straight. It's just bull. Like, I mean, there's no other way to put it. They're not living the lives that we are. None of them are. None of them understand it.
Outgrowth of the original proposal from last summer.
For those people who are not familiar with, that's the legal test for that turns out to be if it's a logical outgrowth. If it's not a logical outgrowth, that would require
like, he's looking at a piece of paper and he's like, oh, inflation went from 5% to 4.9%. You guys should be happy. Like, inflation's going down. It's like, motherfucker, we couldn't afford 2%. And you're happy about it going down 0.1%? Like, bro.
Just because it's the right thing to do. It's what we would do typically in a situation where there are, material
Nancy Pelosi
changes
purchased 10,000 shares of NVIDIA last month, worth between 1 million and 5 million. Yeah, I saw that. But that's what I'm saying. Like, they're just throwing money around, diversifying it because they have too much of it.
The FDIC and the OCC.
They're not worried about paying for groceries every month. They're sending their kids to camp during the summer, or saving up to go on a vacation that they haven't been on one for 5 years.
You would like to go down.
Yes.
If that were the case, would it be fair to say that we'd probably be looking at final determinations or recommendations for a Basel III endgame proposal probably into next year before it would become anything of a final determination?
I think that may be right. It's that something like that could be right. Yeah. I mean, it's hard to be precise. We would put it out. It takes some time to write this stuff up. Then you put it out for comment, then you get the comments, then you read the comments, then you write the final rule. Beginning part of next year is a good guesstimate.
The only reason why I push is because there are so many folks directly involved with this, and the impact on our economy here and with a lot of our financial institutions. This is a significant change, and it's one that a lot of people are following. So I'm trying to get you to get into the depth of this as much as possible, and I thank you for that. I'd also want to go into one other area, and once again, this is something that you and I have had visits about in front of this group before, but I want to talk about what the parts of inflation are and what parts you can control and what parts, as the Fed, you really can't control. The demand side of the equation on inflation is the part that you have the tools to work with. But there is the supply side of the equation, which is still out there. And I want to just lay this out because
what part of this meeting has been good news to bring the market back up to all-time highs?
The starting points that we talk about is when this
all I've heard is dodge.
And as I work my way through this, I just want to share the concern that I've got, and then I recognize you don't want to be political in it, but I want to lay this out, and then I want to talk about what you can control and what you can't control with regard to making changes on inflation through the processes that you have.
Mr. Rounds.
When President Biden took office,
That's this guy's
gasoline
name, look.
prices- Since
Mr.
President
Rounds.
Biden took office, gasoline prices have risen over 54%. Energy prices have risen 41%. Fuel oil prices have risen 37%. Now, I can go on, but you understand what I'm saying is that energy has increased substantially.
Dive, dip,
And I think
dodge,
one of the
and
reasons for this has been
dodge. I
additional
think it
demand
starts
as
with
we've come
dodge,
out of the
doesn't it?
pandemic. But the other part of this has been whether or not investors really want to go back in and invest in traditional energy resources after the president made the specific determination to cancel the Keystone XL pipeline on the day that he stepped into office.
Pivot.
When he did that, he sent one heck of a message to investors
Pivot.
about traditional energy and investing in traditional energy in the United States, and the fact that a multi-billion-dollar contract or contract could be canceled with the stroke of a pen. Now, my question to you is, what percent, or has there been a discussion about what percent or what amount of the inflation that we've seen, over 20% increase in terms of affordability for a lot of our products, how much of that is attributable to the demand side and how much of it really is attributable to supply side challenges that we've seen in this country?
That's a question that we've thought about a lot, and any attempt to reduce that to a precise number would be inappropriate.
Dodge.
Because it's so uncertain. But I think we
Dodge.
can say, I believe strongly, there's a significant demand element
Yep,
and there's
Steve.
a significant supply element, and we've seen the supply side heal so much over
It's
the course
funny,
of the
Zisha.
last year or so, and
It's
we
not
clearly
funny,
see
but-
that that's contributing to lower inflation. We also see cooling demand, for example, in the labor market. So the two forces are working together. I can't really break it down. It would be such an imprecise estimate. I hate
Just
to
simply
say.
just simply an acknowledgement, though, that it is both demand.
It's both. It's definitely
and
both.
it is supply.
It is both, yeah,
Thank
for
you.
sure.
Thank you, Mr. Chairman. My time has expired.
Chair Powell, unemployment has risen by 0.5 percentage point over the past year. The number of job openings
Tell me you got
has
lung
dropped
cancer without telling me you have lung
almost
cancer.
50%. The hiring and quit rates are now below pre-pandemic levels. I'm concerned that if the Fed waits too long to lower rates, the Fed could undo the progress we've made on creating good paying jobs. Full employment is part of the mandate, as you say over and over. How are you assessing the risks of higher interest rates in the labor market?
So I completely agree with your characterization that the latest data do show that we've had considerable cooling in the labor market, and we're very much aware that we have two-sided risks now, as I mentioned earlier, and we're determined to balance those as best we can. We want to see more good inflation data, and we also want to continue to see a strong labor market. And those two things are equal under the law. We have this challenging thing to balance them, but we're very much conscious that that is our job, and we're trying to do that.
Well, and you know that if unemployment trends upward, you must act immediately to protect Americans' jobs. Workers have too much to lose if the Fed overshoots inflation target and causes a completely unnecessary recession. We will say that over and over and over again. I think you understand that. Housing, higher interest rates are making housing more unaffordable. Higher rates are supposed to lower cost, yet housing prices continue to soar. By keeping rates high, the Fed ignores the economic reality of the millions of Americans struggling to make ends meet and get ahead. Let me ask you 3 quick yes or no questions, if you would answer that way. Since late 2022, when the Fed began raising rates, has the volume of housing sales decreased?
I believe it has, yes.
Since late 2022, has the median home price increased?
I believe it has.
Since late 2022, have monthly mortgage payments become more affordable or less affordable for home buyers?
Less affordable.
Okay, thank you. In short, despite housing sales declining, the median price for a single-family home has increased by nearly $20,000. People are spending a greater share of their income in mortgage payments, so in some higher rates, it's clear from your answers and data, it's clear higher rates are not bringing down housing costs. The cost of home ownership is only going up. Let me shift to the Synopsys bankruptcy. Since mid-May, tens of thousands of people, including many Ohioans, have lost access to their money due to the bankruptcy of this fintech middleman. Reports indicate that as much as $95 million may have gone missing. The Fed
Yeah,
oversees one of
Muffy,
former
this is
partner
hard to
banks,
listen to.
Evolve Bank and Trust, is a
It's like they're
regulator. It's your
trying
job
to
make
be
sure that
respectful,
banks protect the people whom they serve. What's the
but also
Fed
trying to
doing
ask hard questions at the
help,
same time.
customers who felt the impact by the Synops collapse? What are you doing to regain access to their money?
So we do supervise the bank. We don't supervise Synapse or let alone the fintechs that feed into Synapse. And we're strongly encouraging Evolve to do whatever it can to help make money available to those depositors. We also, as you may know, did an enforcement action against, before this all happened, we did an inspection or looked at Evolve, and we hit them with an enforcement action around these very risk management issues, again, before the current situation developed.
Okay, it's critical that consumers are made whole as soon as possible. We will continue to talk to you about that. We will watch. We will let you know we're watching. The Fed needs to use its supervisory authority to ensure that Evolve is committing the resources necessary to return those funds to the account holders. Last comment, I want to note one last thing. Last year's Fed report on the failure of Silicon Valley Bank noted how incentive-based compensation encouraged excessive risk-taking that led to the bank's failure. You either watched or had reports of when those bank CEOs testified in front of this committee. The report, the incentive-based compensation that led to the bank's failure, I mentioned, it said that SVB managers, quote,
Yes,
had
they
a
are. Yes,
financial
they are.
incentive to focus on short-term profit over sound risk management. That's what a number of us, Senator Smith, Senator Butler, Senator Warner and I have said over and over, that short-term profit over sound risk management causes significant problems to our financial system. Compensation practices still pose a threat to our banking system. I urge you to move quickly to join your colleagues in the long overdue rulemaking on executive compensation. I mean, you read the reports at the outrage of the public about executive compensation continuing to go up and up and up and up. You have a role, a significant role, a legal role to deal with that. Thank you. Senator Tillis is recognized.
Thank you, Mr. Chair. Chairman, thank you for being here. I want to be real quick on Basel III Endgame, and I want to be mindful of time. Just simply, can I get a commitment from you on releasing the results of the QIS?
Yeah, we plan to release the results of the QIS.
What time frame?
Well, first we have to get agreement with the other banking agencies, but as soon as possible.
Can you imagine any agencies having a concern with, any other banking agencies having a concern with releasing it? Or is it just a matter of
Not
pro
at all.
forma? Okay.
No, it's just a matter of the bigger picture of getting agreement on the revisions to Basel III and also how to proceed.
That's great, and I really appreciate the feedback that I've received from you. I should have started by thanking you again for your continued accessibility and discussions outside of the committee. They're very productive, and I appreciate that. And
He has to.
I grew up in the 70s. Got my Social Security number in 1973 when I was 12 years old. That's when I made my first payment. So I've been following the economy even as a youngster. And that was a really lousy time to enter in the workforce. Tell me, and I'm hearing discussions among some of our members now that would almost be reminiscent of discussions with prior Fed members saying, look, we got to lower interest rates and we've got unemployment out of control. So it sounds like we're taking some suggestions from some of my colleagues or plays from a playbook that didn't prove to be very effective back in the 70s. What can we learn? I'm not going to ask you about where you go from here, but if we look back into a postmortem on some of the decisions that were made when we had consistently high inflation, we had consistently high unemployment, what lessons can we learn there, or what mistakes should we not necessarily repeat? And I know that this is a fingerprint of a challenge. It's not exactly like the stressors that we had back in the 70s, but what can we learn from the decisions, what I think are arguably the wrong decisions made back then when we were dealing with high unemployment and high inflation? What did we learn?
I think the number one thing we learned was that it's up to the central bank to take it on and stick with it until it's done. And that doesn't sound controversial now, but it actually was back then. And so people didn't really get in there and get it done, and inflation kept coming back. I also think there are significant differences this time to the questions a minute ago. This is a combination of a supply side that we had very significant supply shocks along with big demand shocks from the reopening of the economy and from all the other things that happened. So I think we have to, each one of these things is different in its own way. We try to learn the lessons of history, though.
Do you agree or disagree? Any disconnect between inflation and inflation expectations from the 2% target should be addressed now and not at a later time?
Absolutely.
I like that answer. I want to go to something different. I'm trying to go into a lightning round now and finish on time. We've seen the 2024 stress test results for the U.S. banking system. It looks like to me, by every objective measure, we've got a banking system that's on strong financial footing. Do you agree?
Yes.
One last thing is the Fed considers making broad and material changes to the
How can they say
proposal.
that?
Back on that one.
They're just talking about Silicon Valley failing.
Not to overlook the second order issues important to FBOs in certain regionals to ensure the banks are not unduly influenced. If the current proposal, for example, the outsized operational risk costs were high, are we going to take care of that in any sort of reproposal?
Let me just say we're very conscious of the comments across the spectrum: foreign banks, domestic banks, small, medium-sized banks. Everyone's going to get heard carefully as part of this process. That is our obligation.
Okay. And I think in response to Senator Round's question, you did indicate there's probably, because of the nature of the likely changes from what Mr. Barr expected to what may ultimately come, we are going to open it up to comment again.
That's the strong view of the Federal Reserve. We're working on that question with the FDIC and the OCC to try to find a path to do that. But
Very good.
From our standpoint, that's essential.
I think it's a strong view from at least several members on this side of the dais here. That would be very, very important, because I think it's going to materially change. Thank you, Mr. Chair.
Thanks, Senator Tillis. Senator Warner of Virginia is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you again, coming this late in the questioning. I'm going to at least hit a couple of the items that my colleagues have otherwise already hit, because I make sure it's noted that I raised them as well. First of all, I want to agree with the chairman. I probably hear more on housing and housing affordability than any other issue, and I agree with the chairman. I know we've discussed this around a rate cut, and I understand most of your answer, but I still want to add my 2 cents here. We've got to find a way to start bringing mortgage rates down and let people get unlock that housing market. And again, we've discussed the rate cut issue, and I know you've got to navigate that, but I hope it's sooner than later. I will not recap what I've done in the last couple hearings with you, but I do think the discount window proposal that I've gotten, that I know you're working on, before we think about additional regulations that we do need in some cases, I think the discount window is an underused tool, was one of the original tools for the Fed. A lot of my colleagues have talked about quantitative easing, Basel III endgame. I do hope when we get the revisions that we'll see the quantitative analysis that, again, Senator Tillis already raised and other colleagues have raised. I also hope that one of the questions I raised in my March letter to you was, making sure any new regulatory structure, how it intersects with existing regulatory structure in terms of market risk, credit risk, and I, again, hope that we will have that as the revisions come out. I think one of the things that this debate around Basel III raised was that it is, my understanding at least, looked at, you may be all looking at revisions to liquidity standards as well, and wanted to see what you could say about that and whether that part of those standards are under review and what your thinking is.
Yeah, and I think that actually connects to the Silicon Valley Bank questions as well, where I think there seems to be a need to update assumptions about liquidity, and that's a separate proposal that we're also working on, and very important. I think we saw how fast that run was. It was just exponentially faster than prior runs, that's the new world, and you know, that's some estimate of what that world is baked into things like the, you know, the liquidity coverage ratio, for example.
Right, and wasn't that the case, you know, if you had 25 cents on every depository dollar leave in 6 hours, no matter what the capital standards are.
Yeah.
And one of the things, I guess,
I feel like this is
there was a lot of
all
talk
just for
after
show.
SVB that we need to think about internet-driven runs. A lot of us raised concerns. Candidly, I'm not sure I've heard any good proposals, so whether it comes
Think
from
of
you
how
guys or
much
from folks
money,
listening,
how much
how
tax
we
money
think
is
about
being
this new
spent just
internet-driven
on
world. In fact,
salaries
I think some
of the people
irresponsible
in that
behavior
room right now.
by some of the folks that were major depositors in SVB who, in many ways, shouted fire in the crowded theater, and we've not seen any action there. So I would welcome additional ideas as well. And that kind of brings me to my last questions around supervisory reform. I know the GAO criticized the Fed's supervisory procedures in the role they played in the 2023 failures. It is a whole brand new world. Are we going to look at, will your changes to supervisory standards be comprehensive? Will they be one-off? How do you think about that in light of the GAO report and also in light of just the SVB and the few of the other failures we saw last year?
Vice Chair Barr is, who's Vice Chair for Supervision, is leading a process of looking at the way we supervise banks and thinking about how we can be faster where it's appropriate, more forceful where it's appropriate. And I think, you know, they've taken a pretty deep dive and tried to learn these lessons and then implement them in a way that is appropriate. So that's a big project going on at the Fed right now, which really Vice Chair for Supervision leads.
I think I remember lots of conversations with the chairman, with you, with the FDIC, and that Thursday through Sunday. And I think the solution you guys came up with, the administration came up with by Sunday night was a good one, but they were a pretty scary 3 or 4 days there. And it did seem like the process, I don't know completely how you get fully ahead of that, but I firmly believe that there should have been a clearer early warning system and trying to make sure that we wouldn't be in that kind of crisis situation going forward. And again, I would strongly encourage any additional thoughts on this technology risk and how we get that right. Thank you, Mr. Chairman.
Thank you. Senator Order. Senator Kennedy of Louisiana is recognized.
Thank you, Mr. Chairman. Mr. Chairman, our economy is slowing, is it not?
Yes, although still growing at a solid pace.
Our unemployment rate is rising, is it not?
Yes, it is, although the
I
labor
like
market is
this
still
guy
strong.
already.
Our labor market is slowing, is it not?
Yes, but I'd say unemployment is still, you know, is still low by historical standards. But yes, it is. We've seen cooling. Yes.
Mm-hmm. And I was looking at the recent jobs numbers. I know you've glanced at them too. About 3/4 of the net new jobs that were created in June were in government, healthcare, and social assistance. What does that tell you?
So that's a concentration. You'd rather see broader job creation than that. Those three areas have, in some reports, they've been, as it was this time, they've been the predominant creators of jobs. That tells you that job creation is becoming less broad in the economy and it's narrowing.
It tells you that government's creating those jobs, doesn't it?
Well, it's government. It's also in-person services. It's also some of it's government.
Manufacturing's been flat.
Yes, manufacturing's not creating a lot of new jobs these days.
Information technology shed jobs over the past 2 years, hasn't it?
I don't know.
Leisure.
It's my job to know these
hospitality
things, but I don't know.
Jobs have slowed to almost a trickle.
So that's a place where there was a desperate worker shortage, and they've done quite a bit of hiring, but they're catching up now.
I mean, 3/4 of the jobs that are being created in our economy can be related directly or indirectly to our spending deficits, can't they?
In this report, in this single report, I don't know that.
Get him,
healthcare is
Mr.
really,
Kennedy.
Government spending. I mean, that's something people are
Where do you
consuming.
think these hospitals get their money?
They may get it, but I mean, people are not.
Get 'em.
The spending on healthcare is not necessarily directly related to deficits. Is my point.
I would disagree with you.
Oh, glasses
here's
are off.
my point. We talk
He's
a
not
lot
reading
about
anymore. Off the cuff.
expectations in terms of inflation. How if we expect there to be inflation, we'll get inflation. It seems to me that consumer expectations play a bigger role in the economy than we cede to them. Most of our economy in America is consumer driven, is it not?
Yes,
Unlike, say, China, which is manufacturing driven.
very much so.
And I listened to you cite the statistics about the economy, but most Americans don't feel good about the economy, do they?
No, and we don't tell people how to feel about the economy.
I mean, isn't it a fact that most people, if you ask them to define Bidenomics, they would say that's easy. We get to pay more to live worse.
I wouldn't touch
You don't want to answer that
a
one.
sentence with that word in it.
Yeah. I mean, we can pretty this up all I guess my point is, and I know you're going to do this anyway, but I'd be really careful with this economy. I mean, people just don't feel better off today. And one can marshal a persuasive argument that, well, you should, compared to Europe or compared to China.
Yeah, but we're not those places.
Compared to Canada. But feelings are feelings. People don't feel good about this economy. And it's primarily because of inflation. Let me use my final 30 seconds to ask you. I listened to my good friend, the chairman, give his opening statement. Do you think inflation was caused by corporate greed?
Yeah.
I hate to comment on something the chairman was speaking about.
I'll go ahead.
Well, so
I
I
love
would
this
just
guy.
say, we see at the Fed, we see inflation as when there's an imbalance between supply and demand. And we use our tools to work on the demand side of that and bring it back into line with supply.
There's plenty of supply.
Lower interest rates.
I'm today not going to be sending any signals about the timing of any future actions.
Thank you, Mr. Chairman.
Senator Smith of Minnesota is recognized.
Thank you, Mr. Chair. Welcome, Chair Powell. It's good to see you again. I want to follow up on.
Woman speaking, everyone's leaving.
Senator
No, I'm just
Tester
kidding.
was on a bit ago. He was talking about how the U.S. economy has been outperforming.
I know when he said we don't tell
advanced
people how to feel about the
economies around
economy.
the world in terms of growth rates, in terms of unemployment, in terms of inflation, getting inflation under control. Though I think we.
I want to pause just to thought. I'll speed it up to catch back up. First off, Kennedy rocked that shit. That was great. How can they sit here and act like it's not corporate greed? Where everything that has went way up in price, eggs, Coke Zero, like name a product that has went up 3 times in value or in cost, 3 times in cost, and you're telling me that there's a supply issue now. There might have been a supply issue when the prices went up, but is there a supply issue now? No. Should the prices go back down to where they were? Yes. Are these companies reporting record high profits these last year and a half, 2 years? Yes. They're all fucking reporting record high, never before reported type profits these last couple years because they raised the prices. Their supply came back in and they're still charging the same prices when they had to increase the price due to the lack of supply. The supply is back. They're still charging the same fucking prices. That is corporate greed. And the fact that they want to sit here and try to dodge that question is absolute Absolute bullshit. Absolute bullshit.
We obviously can all agree that we're not, at least from my perspective, we're not done yet.
I'll
Don't wanna
only
rest
go
on our
1.5.
laurels, but
I
I'm
don't
wondering
wanna-
if you could share what you think that we have learned from this experience. What have we
I don't
done
wanna
right?
lose you
And
guys.
why is it that we are doing better than some of the other advanced economies in the world?
Chicken at Costco didn't go up.
I think that it's down to the fundamental strengths of our economy. So as you may know, European economic officials are very, very focused on this question. They really, it comes up in all of our discussions. Europe has seen productivity increases of about 1% a year for 40 years. We've seen 2%. If you take a number and compound it at 1%, then compound it at 2%, the difference is just enormous after 40 years in terms of incomes and living standards. And their question is, why is that? Why is that? And the standard answer that Americans tend to give and that I would give is it's down to more flexible labor markets. They in the pandemic, people they stayed in their existing jobs. In the United States, we had people changing jobs at record levels, and that's the kind of thing that adds to productivity and it contributes to rising living standards, going back to school, getting skills, and things like that. Another one is our financial sector. We don't just have banks. We have a highly developed ecosystem of financing sources that will fund early stage investments. Banks are really not set up to do that. They're prudentially regulated, and so those are some of the things. I think we just have these natural strengths as an innovative, more flexible economy. We can grow faster.
I appreciate that. I think sometimes there's a tendency to sort of trash our economy and to sort of say, oh, we suck. And actually, I think that there's great resilience in our economy. I would argue that it has also to do a lot with the incredible resilience of our workers and their creativity and their talent and the training and the education that they have. And I think I would also argue, though I wouldn't expect you to make this case, that the way in which our federal government responded to the pandemic in order to make sure that people weren't evicted, that they still had money to pay their bills even when they weren't able to work, meant that overall our economy survived and was ready to kind of be off to the races when we emerged from the pandemic. But Chair Powell, I'd like to ask you a question, something that you and I have talked about, I continue to be thinking a lot about, which is the commercial real estate risk that we have in this country. I think particularly for office space, we know that has been under strain the last several years. The sector has remained largely stable, but we are hearing about some additional default risk. And one thing that I'm noting is that there's some expectation or concern that may fall disproportionately on smaller banks. I think that commercial and regional banks hold an estimated 2/3 of all the commercial real estate loans in the country. And so unlike larger banks, these smaller institutions might find it a little harder to deal with this. So could you discuss this with us? Could you tell us a little bit about how you see this risk and particularly whether this poses some additional risk that we might be seeing more concentration in the banking sector as these smaller banks are maybe under more pressure?
Yeah, so this, to your point, this is a risk that has been with us and will be with us for some time, probably for years. And banks need to be, honestly assessing what their risk is. They need to be assured that they have the capital and the liquidity and the systems in place to manage this risk. The stress test that we apply to the largest institutions stressed commercial real estate pretty hard. And again, the conclusion is that the large banks can manage this problem. And most small banks can too, but it is in some smaller banks that tend to have that local concentration in commercial real estate. And we're in touch with those banks. The supervisors and regulators are in touch with those banks and making sure that they can manage them. And it's going to be an issue for many banks, but it's one that we're trying to work through, one that we're very much aware of. And again, it'll be with us for some time.
Thank you. I think so much about the importance of these small.
We're going to W right to the
small
highest.
towns, big towns in Minnesota, and how important it is that, in my book, that they can stay independent and better serve their communities in that way. So I worry about this risk. Thank you, Mr. Chair.
Thanks, Mr. Smith. Senator Butler of California is recognized.
Thank you, Mr. Chairman. Chairman, good to see you. And I am going to make you do the whole last 5 minutes since I'm the last one for today. You'll recall the first time that we spoke, I tried to engage you around 3 specific areas. One was how the monetary policy impacts the quality of life for young Americans in the future and the work that you are doing there, the space of climate risk, and what I see as potentially a future challenge down the road, and that is the state of commercial real estate. You and I have had that conversation before, and no surprises today. I'm going to stick to those 3 topics. Somewhat related to questions that you've been asked before relative to the housing market, housing affordability, and interest rates. I want to narrow the scope just a little bit to ask about those issues and challenges impact, again, the quality of life for America's next generation. Given the severe shortage of affordable and available homes to buy, coupled with high interest rates, young Americans are continually unable to afford homes and are pushed into a rental market, driving rental costs up. So there is sort of trickle-down impact here. A recent Washington Post analysis showed that Gen Z is spending 31% more on housing than their millennial counterparts were 10 years ago after adjusting for inflation. How do you view, that was a long lead in to just ask the question, how do you envision or view the interest rates of today and the monetary balancing, policy balancing that the Fed is doing on contributing to the future generation predicament if we are to extrapolate the conditions of today?
So our job, of course, is the whole economy and inflation for the whole economy. And the absolute best thing we can do for younger people
Green Banana, that
is
was
to restore
genius.
price stability.
And I'm
so
sorry.
as we benefited from, I graduated from college in 1975, near the end of the big inflation period. So during most of my adult life, inflation has just been not a factor. And that means, stable interest rates, relatively low interest rates. We want to get back to that. And that is what the Fed's job is that we're not supposed to look at the housing market as separate from the overall economy. In the meantime, though, there's no question that higher interest rates are making it harder to buy homes in the short term. But in the longer term, this is the best thing particularly for younger people who are not yet in the housing market.
Let me sort of in line with that community, constituency, population, and definitely aligned with the concerns of my state that's actually facing some severe climate impacts, just as we speak with wildfires and our colleagues and fellow Americans in Texas and the impact of the hurricane. I wanted to pull in your sort of thoughts about the Fed pilot on the climate scenario exercise. In May, the Fed conducted a pilot climate scenario exercise and asked the 6 largest U.S. banks to examine their balance sheets and how it would be effective if a large hurricane hit the Northeast. They reported facing data gaps on property characteristics, their counterparties and insurance coverage. How does the Federal Reserve intend to invest in expanding the modeling resources for banks that are implementing climate-related financial disclosures?
So we haven't made any decisions on what to do with that information or whether to repeat that exercise. To your point, it was really a learning exercise. How are banks thinking about this, and how are they modeling it, and how does it work really? It's a very, very challenging thing to model. And so that was really the nature of this exercise. In terms of disclosures, we don't really have that's not really our job. That's really the SEC. So, but we don't have a big job on climate, but what it really is to make sure that the institutions we regulate are aware of and understand the risks that they run, including risks from climate.
And that they're prepared, and learning how to, as would be the point of a pilot, learning how to mitigate those risks over time. So what criteria will you use to evaluate whether or not you would run the exercise again and or share more broadly the results of that exercise?
I think we did publish, most of the results of that exercise. So I don't know what to say about that. We're looking at it and we're asking ourselves, what did we learn? What do we need to learn next time? So, I'm not exactly sure what factors we'll be looking at, but we'll be doing a careful assessment of what more we need to do.
Thanks. Thank you, Mr. Chairman.
Senator Hagerty is recognized.
I thought she was the last speaker,
Mr.
and
Chairman.
that, I don't even understand her question.
Powell, welcome. Chairman, last week in Portugal, you said that you wanted to be, quote, more confident that inflation is moving sustainably down before you begin to cut rates. You also said in your testimony that you need greater confidence and more good data before lowering rates. Can you give us any color as to what it is you're looking for in the data and how long it might take us to get there?
We need just to see more good inflation data. That's all. We had 7 months of good inflation data at the end of last year. Then we had a quarter, really a month or so, where inflation went up, and now we had one really good inflation reading and one pretty good one. We just need to see more so that confidence rises. I'm not going to tell.
Are we weeks away, months away?
I'm going to try to avoid sending any really specific signals about time today because it's going to depend on the data. It also matters what's going on in the labor market, though. We've also said that if the labor market weakens unexpectedly, that could be a case for loosening policy as well. Really, we're weighing both those factors.
Here's one of my concerns. I'm sure you probably share it, but we're coming off of a 40-year high in inflation. We've seen the rate of inflation coming down, but we haven't gotten to the 2% target. And my concern, for lack of a better term, is whether or not this might be transitory in terms of the data that we're seeing right now.
That's exactly why we're approaching this question carefully.
I thought that might be your answer. Thank you, Mr. Chairman. Can we shift now to the issuance of Treasury debt? The Fed is the largest holder of Treasury debt. In February, you and I talked about the pressures that our fiscal deficit is exerting on interest rates, which by extension makes your job more difficult. I'd like to talk this time about how Treasury issuance is impacting our economy and our monetary policy. First, just a basic question. If Treasury issuance were to shift drastically, either to the long end or the short end of the curve, would that affect interest rates? Or maybe more simply, do changes in supply across maturities impact interest rates on the yield curve?
I mean, I think in theory they can.
Yeah, I agree. As you know, the Treasury Borrowing Advisory Committee recommends that T-bills comprise between 15 and 20% of total U.S. debt. Right now, the Treasury is issuing T-bills significantly above that recommended range. Some people, including myself, believe that this is being done to artificially stimulate markets in the run-up to the election. And it's shocking how little attention this is getting. Any manipulation of debt management of this nature stimulates inflationary pressures and increases taxpayer burden because it's higher cost to issue these bills. So given that Treasury is issuing in excess of short-term debt, which pulls down longer-term rates, isn't it working at cross purposes with your monetary policy goals of taming inflation?
So we take Treasury's debt management decisions. We don't comment on them. We just do our job.
No, I'm not asking for a comment on their decision, but just as a simple mathematical truth. If they're pulling down demand on the long end of the curve, doesn't that
I wouldn't say that has important inflation implications, no.
You know, it just feels to me the same way that the Biden administration drains the Strategic Petroleum Reserve, that undermines our ability to respond to energy shocks. When the Treasury manages its debt in this manner, it constrains our ability to respond to future economic shocks. And that opens our nation up to very real risk, whether it be amplifying the effects of the Fed's balance sheet reduction, flooding the supply of one of the most important short-term debt instruments. The risks seem to me to be mounting for Treasury market disruption. I'd like to know what your thoughts are, Mr. Chairman, about how the Fed will navigate this and whether you've had discussions with the Treasury about this growing dangerous dynamic.
No, we don't have a seat at the table on Treasury debt management. Treasury makes those decisions, and they don't have a seat at our table on monetary policy.
I just think the risk is very obvious here, though, where we're headed with this type of portfolio management.
Honestly, it's completely out of bounds for me to comment on Treasury debt management in any way.
I think you've been dealt a very difficult hand here, Mr. Chair. The Biden administration's policies aimed to gin up the economy ahead of the election. These efforts directly undermine your policy goals at the Fed. That includes excessive issuance of short-term debt. Think about it, Freddie Mac's backstop of second mortgages, unlawful student debt loan cancellations, the draining of the Strategic Petroleum Reserve to suppress fuel prices, and President Biden's own jawboning of the FOMC to lower rates. As you know, the Federal Reserve was structured to shield monetary policy from political influence, and that independence has given the Fed unique credibility in executing its mission. If the FOMC were influenced in any way by political calculation rather than economic data, it would severely damage the Fed's credibility as an independent institution, it would increase uncertainty in our markets, and it would jeopardize the dollar's status as the global reserve currency. Thank you, Mr. Chair.
Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. When the CEOs of giant banks can boost their bonuses by getting the banks to take on more risk, they run the risk that they will end up running their banks into the ground. It happened in 2008 and it happened again in 2023. Back in 2010, though, Congress passed the Dodd-Frank Act. Section 956 told financial regulators solve this problem. 2 months ago, regulators put forward a proposal, but the Fed refused to join. Now, in 2018, you told this committee, Mr. Chairman, that you, quote, expect that banks will have in place compensation plans that do not provide incentives for excessive risk-taking. In other words, you trusted the banks to write their own rules. So let's see if they actually have. One thing the proposal would do is require big banks to delay bonuses for a broad group of critical employees who are able to gamble with the bank's finances, like the head of a trading desk, for example. Chair Powell, in the 6.5 years since you said trust the banks to regulate themselves, how many of the 10 biggest banks have put policies in place to delay annual bonuses for this broader group of critical employees whose risk-taking could endanger the bank?
I don't know specifically. My guess is all of them. Since the
So
financial crisis.
you're the regulator who said trust the banks to self-regulate so we can avoid another financial meltdown or another bailout. And you don't know if they did or didn't do that?
Well, it's a very, very specific,
Yeah,
narrow
it is a
question
very
you're
specific
asking
thing,
about.
because it's something a regulator should do. You think the answer is 10 out of 10? The answer is 0 out of 10.
Yeah, I doubt that.
Well, go back and look, 'cause we heard the real statements on this.
Ooh.
Another thing the proposed rule would do is require the banks to consider flat-out banning bonuses and bonus pay for executives who took risks that threatened the stability of the bank. So let me ask you this one, Chair Powell, in the 6.5 years since you said trust the banks to regulate themselves, how many of the 10 biggest banks now have policies that would require them to flat out deny bonuses to executives that have engaged in inappropriate risk-taking?
I don't know the answer to that. By the way, I never said trust the banks to regulate themselves.
I'm sorry, do you want me to go back and quote you again exactly?
Trust the banks to regulate themselves?
When you say, I expect that the banks will have in place compensation plans that do not provide incentives for excessive risk-taking.
Right, pursuant to the guidance that we issued in 2010, which is quite detailed.
And you have not issued a guidance since you made these comments, since you became chair. And how many banks have actually put in place the regulations that you said, I expect the banks will have in place? The answer is, out of 10,
it was covered
0.
by the 2010 guidance.
No,
actually.
you said in 2018 that they would put these in place.
I said they would have in
and
place.
No, that is not what you said. So look, Chair Powell, the last guidance on this subject, as you say, was in 2010, which is before you were at the Fed. The Fed has now refused to join the other financial regulators in finalizing a rule implementing Section 956 as Congress directed. So my question has been, how many of the 10 biggest banks have done this? And the answer is 0. Dodd-Frank was passed 14 years ago. There are still no rules to stop banks from rewarding executives' risky behavior. When you were asked about these Section 956 rules or lack of rules, in March of this year, you said, quote, that you wanted to understand the problem we're solving before proposing a rule. Chair Powell, the law does not say Jerome Powell, in his infinite wisdom, should decide if we have a problem with executive compensation. The law passed 14 years ago says executive pay is a problem that threatens the stability of our economy, so write the rules to rein them in. Finally, the other financial regulators have proposed such a rule, but the Fed has not joined. Chair Powell, I understand why the 10 biggest banks in the country like your approach. You let them do whatever they want, but you don't work for the giant banks, you work for the American people. I urge you to do your job. Thank you, Mr. Chairman.
Senator Vance from Ohio is recognized.
He's like, okay.
Thanks, Chair Powell, for being here. I appreciate you coming by our office last week to discuss some of these issues. I wanted to ask something I imagine most of my colleagues are not asking, which is the relationship between immigration, particularly extremely high illegal immigration levels under the Biden administration, and the persistence of the inflation problem. And I recognize this is not your policy focus, but you are the Federal Reserve Chairman, so I just want to get your views on this. And in particular, I want to read you a quote from Mickey Bowman, who's one of your governors. And this says, in a quote, "There's a risk that increased immigration and continued labor market tightness could lead to persistently high core services inflation. Given the current low inventory of affordable housing, the inflow of new immigrants in some geographic areas could result in upward pressure on rents as additional housing supply may take time to materialize. With labor markets remaining tight, wage growth has been elevated at around or above 4%, still higher than the pace consistent with our 2% inflation goal, given trend productivity growth. The Bank of England, I believe, produced a recent report on this issue in the United Kingdom, obviously a different economy in a different country, but what do you see as the relationship, in particular, given that housing is such a big driver of the inflation that we've seen over the last few years? As Senator Haggerty said, the highest in 40 years. What role do you see illegal immigration playing in driving up housing costs, which of course is a main driver of inflation for American citizens?
Let me quickly start by echoing your first comment, which is we don't comment on immigration policy, but we do comment on inflation. So I would say this. Many people came into the country over the last couple of years, many of them through asylum requests, and went to work. Labor supply increased a great deal. It's not, there's no clear answer, but my sense is that in the long run, immigration is kind of neutral on inflation. In the short run, it may actually have helped because the labor market got looser because there were more people. But to you're talking about housing specifically. There will be, I'm sure there are places in the country where new people coming into the country, I'm sure you can find places and they exist where that will have contributed to an already tight housing market. But overall, in terms of aggregate inflation, I wouldn't say it's a driver one way or the other.
So I want to follow up on that thread, but just on that topic of particular areas that have been affected, Chairman Brown, I'd like to ask unanimous consent to submit a letter for the record from the city of Springfield in our state, the southwestern part of our state, which I think highlights a very real example of this particular concern. Straight from the horse's mouth itself. Now, this letter, I want to quote from it. Springfield has seen a surge in population through immigration that has significantly impacted our ability as a community to produce enough housing opportunities for all. Springfield's Haitian population has increased 15 to 20,000 over the last 4 years in a community of under 60,000 previous residents, putting a significant strain on our resources and ability to provide ample housing for all of our residents. And end quote there. And Mike.
Without objection. So
thank you. In my conversations with folks in Springfield, it's not just housing. They're trying to build 5,000 new housing units, which is a very Herculean task in a town of about 55,000 people. But it's also hospital services, it's school services, there are a whole host of ways in which this immigration problem, I think, is having very real human consequences. But I want to go back to just one other question, Chair Powell, on this immigration and labor supply question. So one of the euphemistic ways in which economists, I think, sometimes talk about labor supply and immigration is they'll say something to the effect of, well, an increase in labor supply has put downward pressure on labor prices. And what they're effectively saying is that increased immigration has put downward pressure on the wages of American workers. I wonder, when you hear sort of your colleagues and other economists outside of the Fed talk about the influx of immigration and the fact that it, I think, admittedly has put downward pressure on wages. Okay, so obviously that has put some downward pressure on inflation, but it also puts downward pressure on the wages that people earn to pay for their families. Why do we see that as a good thing? Or maybe that's wrong. Maybe the premise is fundamentally incorrect, but why do so many economists treat an influx of new labor as a good thing? If labor is constrained, labor supply is constrained, doesn't that lead to rising wages for American workers?
So I'm certainly not trying to put a value judgment on it. I will say that this is all happening over the last couple of years in a context of an extremely tight labor
very
market.
true.
Now a little bit less tight, significantly less tight, but you've got a worker shortage. You've got businesses who have jobs that are open. You have, more than one job opening for every unemployed person. So you've got a very tight labor market, and it's addressing that. And we're having wage increases are still very high, but they're coming down to a more sustainable level.
Fair. And Mr. Chair, I know I'm over time. Could I just one more question on this? Thank you. I understand your point, Chair Powell, and again, I'm not ascribing value judgments to you, but if we say we have a really tight labor market, and we say that there are more than one job openings per worker, There are two ways you could plausibly solve that, probably more than that, but two obvious ways you could plausibly solve that. One is through a new influx of workers via the immigration system. Another way is by raising wages and bringing some of the workers that are on the sidelines. I think specifically of the 7 million prime age men that have dropped out of the labor force. Like, why isn't that more the focus of policymakers rather than, you see a labor shortage, rather than bringing in a large number of new immigrants, why not try to boost wages in a way that brings some of those workers off the sidelines? That seems to be a much better focus from my perspective.
Certainly, that's a very constructive focus. I would agree. It's not, I don't think it has to be one or the other.
Thank you, Mr. Chairman.
Senator Van Hollen from Maryland's recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you.
Represent!
And let me first applaud
I hate
you
this
and
guy.
your team
I've
at
met
the
this guy
Fed
in person.
For at least so far, being on track to bring down inflation.
I don't hate
without
him, but
so
I dislike
far
him.
triggering a surge, big uptick in unemployment. But you know very well that that's a risk if the Fed does not act with full awareness of that danger. When you were here in March, you said that you were, quote, well aware, unquote, of the risk to unemployment of waiting too long to cut rates and, quote, very conscious of avoiding it, unquote. Since then, we have seen a slowing in the economy and a rise in unemployment. I'm just reading something today, an analysis with Diane Swank, KPMG's chief economist, who summed it up by saying, quote, the ice is thinning, red flags are emerging for the U.S. economy, unquote. The engine of the economy, the labor market, is cooling faster than previously known. The unemployment rate is above 4% for the first time since 2021. It is taking workers longer to find jobs. Economic activity in the service sector, which is responsible for 2/3 of economic growth, slowed in June. So my question, Mr. Chairman, is how do you take all of these factors into account? Do you share my concern that as of today, there is a real risk of a increase in unemployment larger
These are just
than
this is just an
currently on your
eval.
radar
The My Fund of Futures eval.
Yeah, I mean, absolutely. I do.
I would not
even
be
more
doing
so
this
than
with a
in
PA
March when
account.
we were here, see that. So we've seen, and I think the latest data show that labor market conditions have now cooled considerably from where they were 2 years ago. And I
I
wouldn't
really
expect
think
that
we're
to
gonna
take
head
us
back
up
up, but just couldn't catch
and
the
I would
bottom.
say also that
I mean,
for a long time the risks were more that we would fail to hit our inflation.
I gave enough
target.
back
I
on
think
this
the
first
risks
attempt.
as to the two statutory targets we have, price stability and maximum employment, I think those are coming much more into balance. My colleagues and I are looking at that, and we fully understand that we have to manage this.
Thought this was going to just be a good sweep,
of
green to
administering the
red,
federal funds rate
then
and
back
deciding what
green.
to do with it
And I thought
in a
we were
way
just
that
going to go
manages
up from
both
there,
of those
but
risks. And the two mandates are equal under the
nope.
law. And so, yes, we do get that.
Well, I appreciate that, and I appreciate the fact that you've seen that sort of that calculation change since you were last here, because I think the data indicates that we are at risk now of not acting soon enough to curb the increase in unemployment, and that if we allow that to go too long, we may see a real uptick there. And so I'm pleased that that is very, very much on your radar screen, and hope that that will be a really deciding factor as you and your other Fed colleagues determine what to do with respect to interest rates. And as has been said in the housing sector, we are seeing the continuing drag created by high interest rates. So that has been I think all of our colleagues, as you probably heard today, are really hearing from our constituents, understandably, about the very high housing prices. And it's slowed investment in other sectors like manufacturing as well. In my final minute, I would like to turn to the question that Senator Warren
doesn't want to go through.
I asked your colleague, Vice Chair Barr, about exactly this question of implementing Section 956 of Dodd-Frank when he was before the committee just a short time ago, May 16th of this year. And I asked him about why the Fed had not moved forward along with other agencies with respect to implementing what the law is and what the law has.
No, I'm going to go to the gym here probably around 12, in like 20 minutes or so.
The SEC has indicated that they're moving forward. I said to Vice Chair Barr that I've not seen any notice of proposed rule from the Fed, and can I get a commitment that the Fed will quickly begin to process implementing this law by issuing a notice of proposed rule? His answer was, and I'm quoting, "In discussions with my colleagues, it became apparent that at the board, we believe we need to conduct some further analysis before deciding what steps to take. We are committed to following the law, to implementing Section 956, but we have further work to do." Count me among those who are very frustrated that we're now 10 years after this law was passed. Vice Chair Barr committed to following the law. I'm sure, Mr. Chairman, you would commit to following the law. But why is it that it's taking the Fed so long to move forward with implementation of 956?
So I like to look at the actual language of the statute when what
Still
it says is
testifying.
it calls on the regulators to make determinations about specific incentive compensation practices that cause excessive risk taking, and then and we haven't done that. We did. You know that we put in place pretty serious guidance back in 2010 after putting it out for comment. We looked at all these questions. It's been in place for 14 years. We supervise on it. And, so the question I'm asking is, okay, let's go out and look at what the practices are that are happening now, not that are happening before the global financial crisis when it was obvious that things needed to be changed. And we put the guidance in place. It seems to have largely worked, certainly as it relates to the large firms. And then let's design something that is designed to the residual risk as opposed to just taking something off the shelf from 15 years ago and doing that. So and we're working on that at the Fed now. And again, the statute requires us to prescribe regulations or guidelines to prohibit those things, and I want to do that. In a sense, we have done
just very briefly. And is it your testimony that
Why does this guy get to
Fed
talk for so
has
long?
already met the requirements of site? Okay,
no,
just want to make that clear, and we do look forward to the Fed moving forward. Thank you, Mr. Chairman.
Thank you, Senator Van Hollen. Senator Brett from Alabama is recognized.
Thank you, Mr. Chairman. Chair Powell, thank you for being with us today. My colleague from Maryland actually just touched on something, but as I was listening to the exchange from my colleague from Massachusetts and her closing remarks, particularly about Dodd-Frank and 956, there was also a comment at the end where she mentioned you working for giant banks versus the American people. Now, I have a long list of questions I want to talk to you about, but I did want to get you to respond to that.
Yeah, that's completely untrue. The things that we're doing are consistent with our international obligations, and they're meant to be the best thing for the American economy, and that's really our only consideration. We have policy differences across various things, but we're all trying to achieve the best results we can for the people that we serve.
Absolutely, thank you. Chair Powell, I have repeatedly talked about my concern with
She doesn't sound like she's from Alabama.
And just think that it has not been
Imposter.
well thought through. First, I have concerns that it blatantly undermines the tailoring requirement. And on that note, do you believe that 2155 will be applicable to the long-term debt requirement?
I think it applies to everything.
Absolutely.
And on the long-term debt requirement, we have voluminous comments that we're looking at carefully and thinking through the process of what to do about them.
No, I appreciate that because I do believe that currently it lacks a real cost-benefit analysis, and I think it really does need serious reconsideration. And additionally, when you take a look at it and its overlapping nature with Basel III, it seems inappropriate that we would move forward with a new long-term debt proposal, finalizing that rule when we don't even really understand what Basel III is going to mean for capital requirements for banks and obviously financial institutions. So my question for you is just that. Would it be inappropriate to move forward with the long-term debt proposal, finalizing that rule prior to Basel III being finalized as well?
I don't know that I would give you, I can't give you a clear answer on that. It will depend. I mean, Basel III won't be finalized for some time, but that's not to say we wouldn't reach a place where people understand and accept and support what it is that we're doing. And I think at that point, we could certainly move forward with other rules.
I heard you mention to one of my other colleagues that probably by the time this all took place, it would be the beginning of next year. I would just say my concern, the Fed has said that the long-term debt rule will directly be impacted by the final Basel product. And so, why would it be inappropriate or appropriate to move forward with that before banks can fully understand what they're facing from Basel? So I would just ask that y'all are thoughtful about that. These are a lot of things that people are dealing with and trying to really understand the implications of. And I think we have seen consistently that people are not taking a look at the cumulative impact of these things and not really taking a look at the trickle-down effect. And on that, on Basel, when you testified in March, you said the Fed was aware and fully considering the potential impacts of a proposal on our commodities markets. And I do want to talk about that. The commodities market, our agriculture industry is 1 in 5 jobs in the state of Alabama. It's 20% of our economy. I am a big believer food security is national security. And the proposal would increase hedging costs by 80%, meaning banks would be far less likely or inclined to offer clearing services. So this could have a detrimental effect to our agriculture community and increase other costs providing food and fiber for our nation. When you look at inputs such as feed, seed, fertilizer prices, those have skyrocketed.
Finally breaking
and
that
prices have ended
lower
up
low.
just getting passed down to the consumer. I mean, grocery prices are up 21% since January. So do you believe that the revised Basel proposal will alleviate these concerns that our farmers
Biden
and our
would be
ag
asleep.
community have had about Basel III?
No chance he's still
And has
awake.
the Fed done anything specifically to take a look at this? And if not, will you commit to doing so?
So I don't want to get into the specific changes that we're going to make. I'll just say that we're very well aware of and very focused on that particular set of changes and, paying close attention to the issues you've raised.
I appreciate that. And I also hope that the Fed when you craft these types of regulation, you really consider the relationship between the economic impact and the ability of community banks to serve their communities as well. I have heard you mention that to another one of my colleagues, so I know that you're committed to doing that. But that is incredibly important to Alabamians and our main streets all across the state. In my last few seconds, I want to touch on one more topic. So finding solutions to expanding affordable childcare is a top priority of mine. And it is something that I know a number of my colleagues on the other side of the aisle share an interest in and believe is an important issue as well. So Chair Powell, do you believe that increasing access to affordable childcare would positively impact labor participation in our country?
I do believe that.
Thank you.
Stowe of Nevada is recognized.
Thank you. Excuse me, Chairman Powell, thank you for joining us. And I always appreciate visiting with you in my office as well and your comments. Let me start by a comment you made in the opening. Over the past 2 years, you said the economy has made considerable progress toward the Federal Reserve's 2% inflation goal. Labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. And what we know is that since Biden came into office, the United States has added over 15 million jobs. Under President Biden, we had 41 consecutive months of job growth.
See, Sean.
We just said it again here today that wages are up as well. Average U.S. wages and salaries grew by nearly, 16,700 between January 2021 and April 2024. So would you agree with the statement by a ranking member earlier today that the U.S. has the greatest economy on the planet?
I certainly would.
Let me ask you this. Jumping around, and there's been talks today about the Fed's independence and how important the Fed's independence is. The Wall Street Journal recently reported former Trump administration officials drafted policy options to weaken the independence of the Federal Reserve if President Trump were to be elected in November. Allegedly, former administration officials discussed policy options to erode the Fed's independence to make it easier for a president to impact interest rate decisions or fire the Fed chair at will.
I'm not sure,
Chairman Powell,
David.
how
I've just been
important
kind of along for the
is
ride.
it that the Fed has independence to provide economic stability and anchor our inflation expectations?
So I think it's actually essential. It's literally essential. And the good news is I think that's pretty broadly understood, and particularly on Capitol Hill, on both sides of the aisle. I believe that people do understand that we need to do our work in a way that's outside the political process to the maximum extent possible. Of course, we need to be accountable and tremendously transparent. If you look at the box in the Monetary Policy Report on central bank independence, it's really a box about transparency. That's the other side. So I think it's really important. I think it's an institutional arrangement that has served the public well. And, and I do believe that there's pretty wide support for it.
And you just said it has been intentional and institutional arrangement over the years for this very reason, correct?
Yes, this is a choice that we make. And I think it's countries around the world, advanced economies, have all made this choice effectively. And the results are clear that you now have independent central banks, and you have better anchored inflation expectations, and you have better performance on inflation and better performance in the economy generally, which isn't to say there won't be shocks and
I think they're doing everything they can to make it look like nothing's wrong until the election.
That one of my colleagues just talked
That's
about.
what
So
I
was
think
gonna
they're
ask
doing.
about this, which is our immigration. In Nevada, immigrants are extremely important for our economy. They're essential workers, doctors, nurses, and teachers in my community. Can you, without getting into other
I think everybody
ancillary
knows
issues
that at this
don't
point.
impact what you do, can you talk about and elaborate on how immigration affects the employment rate and
Trump
why
can't-
you look at it, and for what
Trump can't
reason
use
you
that
look at the immigration issue?
as a bonus to people voting for him to fix the economy if the economy is already doing great
immigration policy.
at the
We have no
time of election.
responsibility for it. It's not our job. But so we just look at the numbers, and we sort of try to assess
Yeah,
the
till
economic
November.
consequences of immigration.
Go look at the
over
daily
last
chart of the
2
markets
years,
last November
2 years ago, we had an economy where we really had a labor
to
shortage.
today.
And what's happened is we've had a wave of immigration.
Look at this.
And many of those people have gone to work and gone to work legally through the asylum process. Not all of them. There's also a group that has not been legally processed, but many of this latest group have been
Right here.
sought asylum and
Literally
gotten
November
gone through the
1st,
process of getting
like, well, the end of October
So what
going
that
into
means
November
is that
1st. Look at what the market's
employers
done
wanted workers,
since then.
and there are now
Essentially
there were
straight up.
more job openings than there were people.
When
actively
did
seeking work
election
or
season
working.
start?
And so now you have a new supply of
Coincidence?
workers, and they fill those jobs. So we have a bigger economy, but it's not a tighter economy because labor supply has increased the economic capacity. That's just the arithmetic. That's not saying it's a good thing or a bad thing. There are
And
other
so-
policy choices that could be made, and they're not for us to make.
When you say greater economy,
A larger economy.
in
Yeah,
other
David,
words,
I
it
agree.
has improved the growth of our economy.
Right, the economy grew
Couldn't agree more.
3 something
I think we're on the same
3.4%,
page.
I believe, last year. And some part of that was that as
It's not-
Congressional Budget Office
you couldn't have said that better. The
analysis
stock market
showed,
is not the
and
economy.
to
But guess who
many
controls the
surprise, there
stock
had been
market?
A really significant uncounted group.
Guess who
of
talks?
workers
Guess
coming
who
into the country
controls?
had gone
Who
to
says
work.
what about the economy?
And that's part of the story of how the economy managed to grow.
Go ahead, bring
that
out the
much
Illuminati.
While inflation was coming down pretty sharply. Inflation came down 2 full percentage points during 2023, while the economy was growing at 3.4%. So, and while these people were coming in, so that is part of the explanation.
Fed,
for
no, the
why we
Fed,
had such an
they can act like they're
pretty good
out for
year
your
in
best interest all they
2023.
want.
Thank you.
They might be, but not while Powell is the one
Mr. Chairman, thank you, Chairman.
being the spear
As
of it all.
always, all of my prep goes out the window with the last question. So on the legal immigration workforce front, and I know this isn't your bailiwick, but the issue of workforce is important to the economy.
Exactly.
I would submit to my colleagues,
He's too deep at this point.
beyond even the people
And too
who
late in
come
his
to seek an
career,
asylum
his
suddenly being
life.
available for the workforce. We have a
There's no
million
point for him to
plus
change.
people who we welcome in legally every year, the vast majority of whom don't come in with a job or even a skill set. We have so much work to do, colleagues, on the legal immigration front.
Yeah, but that's the whole
to
point, Zishan. We're not
create,
trying to make everyone happy.
A connection between economic demands for
We're trying to make the
workers and
people
skill set and
that are
education
happy because they have all the money realize
So,
that
most every other country
they are
requires
1%.
some sort of skill set.
They're 1% of the
useful in
population in the United States.
We don't do
The other
much of that. So
99%
that's just
don't
my
have
speech
money,
for the moment.
not the kind of
I
money
know,
that they
Mr. Chairman,
have.
you've gotten already
And they
lots of
just
very
don't
specific
understand that.
questions, and I've heard a couple of them on Basel III. So I'm just going to make an illustration, and you can comment on it if you'd like. But there's a large generation and transmission utility in North Dakota, rural electric cooperative, Basin Electric, very large G&T, members all over the upper Midwest. And they recently testified in front of the CFTC on Basel III, and they expressed a concern about how operations would be impacted if lending was curtailed or limited in any way. And they gave a real-world example, and I want to just give you that example. Now, remember, this is an electricity supply that we're talking about. It's critical it remains reliable. It's critical that it remains affordable. And part of an electric cooperative's risk management program, of course, is how it buys the fuel that generates the electricity. In this case, natural gas. They may buy natural gas in advance at a fixed price.
Why is this
realizing
line
natural
still
gas
going? I
always
thought I had
goes
it
up
stop at
and down,
10:30.
pretty big
Why is it
swings at
still
times.
going across?
But they can hedge by buying
Oh, it's not.
at a
It's
fixed price
stopped here.
for a
Okay.
power plant.
Never mind.
And it protects the cooperative financially, since electricity prices, again, follow those spot prices generally. So if spot prices spike, so do electricity prices. However, with a natural gas hedge, the cooperative can generate electricity at a lower fixed fuel cost, protecting itself and its consumers from high prices. It's an upfront cost on the balance sheet between the cooperative and its bank.
Well, that's the problem,
but
David,
it
is
protects the reliability and affordable
the best
supply
thing
of
that the nation
electricity.
could
I
do
give
is
you that
out with the
very
old and with the
specific
new.
example.
It's really the only
Not to
way.
mention that the cooperative model itself has
But even in that, we would have to hope that the new people coming in don't fall into
you've already stated
the
that
same system
there
that's
can
already
have
in
to be
place.
changes. I just throw that into your box of things to think about, and you're welcome to comment if you'd like.
There's a lot of people that look like
well aware
Powell,
of that
that
issue,
look
and I
like
appreciate you
Biden,
bringing it up.
that
Thank you, Mr. Chairman.
what happens
With
when they
that,
go,
then,
that look like Pelosi.
I'm just gonna
Like, how are, like, just
speak to
look
this
at them.
independence issue. I
They're
think
not
that
healthy.
Senators that have questioned you on it are correct. I share that concern, as you know, that this independence.
That's
that
the
is
first thing they need to do
essential.
is get rid of the whole
resisted, moves
term
within
limits
my own party
or
to change it.
lack thereof.
But those moves are very narrow and not very, I don't think, very realistic. And I appreciate you pointing out that from what you can tell,
Yep.
at least on
And
Capitol Hill, we're all.
That's
pretty
what I
much
was
in
saying
that
earlier. I
front.
don't think either of you were
Perception does
here.
matter. It matters a great deal. And
Like,
you and I have had
imagine the
discussions
salaries
over
being
the
paid
years
just
on-
in this room
you were
that we're
very,
watching right now.
You admonished us strongly as
None
Congress
of
to
them
spend
know
we
what
needed
we're
to
going
spend to
through.
get through
None
the
of them.
pandemic and to maintain the economy.
Everything they're saying
you
is
were
just
right to do
based off
that.
of crap that they're being told on a daily basis by
just
the
as
people that are
aggressive in not
actually going through
responding
it.
to calls to rein it in a little bit when
None of them
Democrats brought
actually give a shit.
The Inflation Reduction Act and the American Rescue Plan.
Exactly.
to the
None of them
forefront,
actually
and,
care. This is all just a
really
show.
Basically hijack the economy and
What
put
are those
fuel on
bands? They're the
inflation.
Keltner channels.
But perception matters, and so I would just submit to you,
13
and you already
MA,
said you're going to do this.
4
I don't
standard deviation.
believe you'll do this, but any move to lower interest rates or move interest rates either
The idea
direction
behind using them is every time it touches,
bad perception,
you look for the
even if
reversal.
there's, even if
Which
there's a
this is
strong,
the only time it touched today.
push to do that.
It's the
I
only
know you
time it actually
understand
gave
that,
me an
but I
alert,
just want you
and
to
it
know
worked
that as long as you
almost
remain
immediately.
independent,
It
I'll
was
be on your
during when
side.
I thought the news was happening when
neutral is
Powell was
good
talking, so I
And by
didn't
the
touch
way,
it,
you have one of
but it
those
still
jobs
worked.
where being boring is one of the most noble things you can be. So great job. Thank
We do
you.
our
Thank you,
best.
Mr.
Senator Kramer, Senator
But he's
Warnock
not being
is
boring. That's the
recognized.
problem.
Who's decidedly not boring.
We wouldn't be talking about this shit if he was doing his job. People don't understand that. We wouldn't be talking about inflation if there wasn't inflation.
Policy report shows inflation is in housing costs is gradually easing. That's good news. But many Georgians still feel the sting of unaffordable homes and mortgages. And one reason for this, you and I have discussed this.
Just don't ever ask us. Don't ever take a free trip. Don't ever take any of that. You don't have to worry about it. That's been my firm stance from the get. That's why you don't see me sponsored by anybody that I don't
We've discussed
solely
this
believe
issue,
in,
particularly
which
the
I'm not
effects
sponsored by
of
anybody,
the
nor have I
housing
ever
supply
been.
on housing costs. And we agreed that while the Federal Reserve does not control housing supply,
I would be sponsored by Balls if
it
they would let
can
me,
help
though.
create the environment that
They won't even
encourages
return my email.
construction of new housing, particularly affordable housing. Chair Powell, how has the Fed been working to foster an environment that encourages home construction, and what, in your view, are the challenges that remain?
So, I mean, in the long run, the absolute best thing we can do for the housing market and for the economy is to sustainably bring inflation back down so that people aren't talking about it anymore. And it's just assumed
literally just said
by
that.
everybody in their daily lives that inflation will be around 2%, so we don't need to
Yeah,
be
spell
talking
it
about
right,
which is where we were
T-Sean.
for a long time. We want to get back to that. Interest rates can come down then, and the housing market can return to the state it was in before the pandemic, which was to say really tight. We don't have enough housing, and that's not really a monetary policy issue. In the short term, though, you know, I would say tight monetary policy weighs on the housing market. You know, the policy works through interest-sensitive spending, and housing is definitely at the top of the list of interest-sensitive spending. So we understand that, you know, we're suppressing, not suppressing, but our higher interest rates, you know, have led to lower housing starts and lower activity in the housing market. But we're doing that to get back to 2% inflation for the whole economy, so that the housing market can be on a better foundation.
Well, yeah, and related to that, when you have these high interest rates, of course, you see across the country, but particularly in a state like Georgia, these institutional investors who are coming into the space, and they're buying houses in all cash, boxing out first-time, first-generation home buyers. And, of course, the conditions for them doing that improve.
Well, yeah, they're going to
today
keep pushing it
with
up as
higher
long as they can.
interest rates. Would you agree with that assessment?
I know some of that's happening. I don't know that higher interest rates make it. I mean, some of that's, they're working with.
Well, you got higher interest rates and you got institutional buyers who can purchase it all cash. Doesn't that further?
But they have to borrow the money at higher interest rates. I'm just saying higher interest rates doesn't make their investment any cheaper. And notwithstanding, I understand it's a sensitive issue, and in most markets, it's still a pretty small portion of the outstanding housing stock. But it's not an issue. It's not an issue for us. You know, they're a legal buyer of housing. Our job is really the whole economy. I mean, it's more of a question for legislatures.
So how can the Fed better deploy its monetary tools to ensure that we are meeting key inflation objectives like housing affordability?
You know, I think the best thing we can do is to is kind of what we think we've been doing, which is to
what's up,
move
Fletcher?
carefully as we think about loosening policy and make sure that once that we do that, when we've got greater confidence that inflation is moving sustainably down toward 2%. We're also keeping a close eye on the labor market, and if we see unexpected weakening there, then we could respond to that too. But that's really the best thing we can do for the whole economy, and very specifically for the housing market too.
You well point out that you're limited in terms of your influence there, and there is a role for Congress, to be sure, which is one of the reasons I wanted to be on this committee, to introduce a down payment toward Equity Act with my colleague, Senator Butler. This bill would help first-generation home buyers compete with Wall Street institutional investors by helping with down payment costs, closing costs, and costs to reduce interest rates. I look forward to continuing productive conversations with you and looking at how we can
This
make
guy's an
housing
ass
more
kisser.
affordable for all of Americans. I'm running out of time here, but one of the other concerns that I maintain is with respect to reducing the racial wealth gap is this issue around home appraisals. And the Fed is part of the interagency task force on property appraisal and valuation equity. What expertise and perspective has the Fed brought to this task force? You know, how are you responding to this issue of home appraisals?
So, as you know, we've been an active participant in that task force, and, we bring all of the expertise we have in the housing market, as well as regulatory, supervisory, and economic expertise generally, as we look at that. And I'll also say that our strongly held view is that discrimination has no place in the banking system, and that includes appraisals and other valuations.
I agree with that, and quickly, I was glad to see that CFPB and other agencies recently finalized a rule that creates strong anti-discrimination standards for automated home evaluations. The Fed has not yet approved this rule. Why not, and does the Fed plan to do so?
Sorry, why do we?
You've not yet approved the rule that was made, that was suggested by the CFPB. They finalized the rule.
But do we? Sorry. I'm not aware that it's a rule that we have to finalize too. Is that the case?
That is my understanding.
Let me follow up with you on that. I'm not aware of that.
Okay.
Thank you.
Senator Daines of Montana is recognized.
Chairman, thank you. Chairman Powell, thanks for being here today.
No, I don't think. Well, I'm not in the trade.
Election season's in full swing, and so from now until Election Day, my Democratic colleagues in Congress, as well as the Biden-Harris administration, will waste no time attempting to sell a fairy tale to the American people that financially and economically they are better off now than they were almost 4 years ago. When President Biden took office, inflation was at 1.4%. His failed policies drove us to the highest inflation we've seen in 40 years. I can tell you the folks back home in Montana aren't fooled, because in every part of their lives, inflation is not some kind of hypothetical. They see the everyday impacts of the decades-high inflation brought on by the policies of the Biden administration and facilitated by congressional Democrats. The cost of most goods and services across the economy are more expensive than they were in 2020, and that is a fact that no amount of political spin or mental gymnastics can make go away. Here's just a couple of examples. Breakfast cereal. Prices have increased 28% since January of 2020. Gas prices increased 36% from a national average of $2.63 a gallon to $3.58 per gallon. Egg prices have jumped $3 per dozen in 2024, double the cost of $1.45 in February of 2020. And this dishonesty doesn't stop with inflation. On the labor market, while President Biden and Senate Democrats are celebrating a victory lap in light of the recent jobs report showing a 206,000 new jobs last month, they're willfully ignoring the fact that more than a third of these job gains came from the government sector. Mr. Chairman, I commend you for the job you have done thus far in trying to rein in inflation. I encourage you to continue the fight despite the political pressures.
Let me pull my pants down.
I'm also encouraged by the comments you made earlier this month about the dire need for Washington to address its fiscal imbalance. I couldn't agree more. I've said many times and continue to believe that Washington's culture of reckless spending, of excessive borrowing, is leading us down a very dangerous path by leaving future generations with mountains of debt. And I'm happy to hear you agree with that assessment. Mr. Chairman, given that it's an election year, you're undoubtedly facing
It's like they were like, this is wrong, this is wrong, this is wrong. I commend you.
Thus far, you've done an admirable job in using the tools at your disposal to fight inflation, and I urge you to continue to be led by data.
I thought that one woman like an hour ago said she was the last one.
You said as recently as last week that while things are trending in the right direction, you would need to see further evidence before cutting rates. So here's my question, Mr. Chairman. What specifically are you looking at and looking for as we head into the next FOMC meeting, and how do you factor in this recent labor data, and certainly the significant part of that being government jobs?
So we're looking for two things, really. One is just more good inflation data. And we had quite a lot of good inflation data the last 7 months of last year. Then we had kind of a bump in inflation in the first quarter. And now we've had one good and one very good inflation reading, and we need more good data so that we can be confident that what we're seeing is really, that's where inflation's going, that it's going back down toward 2%. We don't need to see it at 2%. Right now, we're at 2.6%. So that's on inflation. On the labor market, to your question, we've seen that the labor market has cooled really significantly across so many measures, and a number of people here today have pointed them out, and the unemployment rate has moved up. You see a labor market that is now pretty much in balance, pretty much where it was in 2019. It's not a source of broad inflationary pressures for the economy now, but it's still a strong labor market. 4.1% unemployment is a very good and historically low unemployment rate. So we have a mandate to support maximum employment, and we also are paying close attention. And if we see that the labor market were weakening unexpectedly, which is to say, more than what we've seen in a material way, unexpectedly, then we could also respond to that, because we have a dual mandate, and we now see the two mandates as more in balance than they were a year ago. Really, the focus had to be and was on inflation. Now we need to be focusing on both goals.
Actually, a decent amount of
Chairman,
people
thank you. I want to get one question on Basel III, and then we will. In March, this committee agreed that it was seriously flawed and needed to be completely rewritten. I was encouraged to see reports last month that the Federal Reserve had provided other financial regulations with possible changes to the proposal. My question is, I continue to believe the proposal should be scrapped altogether, but could you share what changes you're planning to make and the status of the ongoing development of the updated proposal?
So we've had extensive discussions led by Vice Chair for Supervision Barr with the FDIC and the OCC. We've made a lot of progress in getting close to an agreement on a set of proposed changes. The work that remains is to agree on a process forward. How are we going to move forward? It is our view institutionally that we need to put the changes out for comment for some period of time so that the public, all members of the public who want to comment, can see them again and comment on them again, and see them in the context of the quantitative impact survey that we did. And that's the right way to proceed. That's how we would ordinarily proceed, and we don't see why we would deviate from that. And this is the conversation we're now having with the leadership of the FDIC and the OCC. And my hope is that we'll be able to come together around a way to proceed forward, very soon. I'd hope we would have done so by now, but I believe we will do so fairly soon.
Thank you for joining us today, Chair Powell. I look forward to working with you to strengthen this economy. For senators who wish to submit questions for the hearing record,
done.
they're due 1 week from today, July 16th. To Chair Powell, please submit your responses to questions for the record 45 days, no more than 45 days from the day you receive them. Thank you for your testimony. The committee's adjourned.
All right, well, that's finally over. Mohammed, howdy, howdy. Yeah, I'm still gonna go. I wasn't expecting that to take that long. I really, really, really want to take a trade to try to get this payout before tomorrow. Because the 11th is when they rebill. I think it's the 11th. Let me check. Yeah, it's the 11th. 50 likes, $20. That's if it happens by 11 o'clock. It's a little past 11 o'clock. We can still play marbles, though. Let's see. My new Rhythmic funded account is pending activation. What does that mean? Account is pending activation. Please pay the activation fee. Okay. Because this is still the old account. Are you only trading as of right now? I mean, we've been absolutely nowhere near the bands, and I'm not trading the Apex account until we get towards the bands. All right, I'm gonna start the marbles, exclamation point marbles in the chat. It's not gonna be for any money. It's just for fun. If you would like to participate, exclamation point marbles in the chat. We'll do it at 12:20. 12:20. Sure, you got 3.5 minutes. Yeah, there's 43 people in here, and I'm counting 1, 2, 3, 4, 5, 6, 7, 8 people in the marbles race. Steve, I don't think most people want to play. You might win. I guess I'll put myself in there too. We'll give it 2 more minutes. Do 12:22. It's not for money, so I won't do a cutoff. How'd everybody else do today? Haven't checked in on anybody. David took a mac sauce today. Sad face. Alpine looks like he's getting spanked. He's getting spankarooed a little bit. Up 220 on micros. Let's go. 22 bucks green. Let's go. Max loss. Not good. I do not like hearing that. Little red on some and a little green on others. That's not bad. He's got his current title to negative 16,945. So basically negative 17,000. It's scrolled down though, so I can't see it. But not a great day for him. Although a lot of those accounts look like they're well within payout. Oh, these are all pending. Red on Inini Val, but green on PA. Nice. That's best case scenario. Top step combine, but positive day. Nice. If you guys would like to have a little bit of fun playing some marbles, exclamation point marbles in the chat. Give it like another minute. Alrighty. I think if I just leave it running, if for some reason we were to do a second race, it should... I don't know why it does this. It only does it on the marbles one. So now I got to go to Streamlabs. Go to the overlays, edit, save, see if it works. Where is it? Where is the... So there it is. All right, off, save. On, save. There we go. I don't know why it does that. It's so annoying. All right. So we're going to try this one. Bots. Add names. Clear. Open. All right. I got 15 people, including myself. See what happens. Never done this one before, I don't think. Looks like we got some Plinko. Go straight down. Oh. Oh, this is actually one that I was looking for. Where you run into the bear. Oh, yes. I love this one. Okay. This is going to be one of the other ones that we do from now on. I was looking for this one before and I couldn't find it. And now we have. All right. 5, 4, 3, 2, 1, go. It's another one of the catch-ups. Play a lot of catch-up. So even if you're in first, doesn't mean you're going to finish first. Smitty first one. Nope. Mike, maybe. Gabor, maybe. Crawford, maybe. Ivan. Let the race begin. Into the first tire set. Ivan. Crawford. Ooh, look at Crawford. Almost got around. Almost. He's through. Mike is through. Gaber, Fletcher, Ivan. Who's going to get the tire tracks? There's our Crawford. Off to the next tires. Here we go. Crawford right into the middle, it looks like. Little bouncy bounce. Gaber, David, everybody piling up. Anyone still behind? Oh, yeah. We're all playing catch up. Let's go. Who's out in front? Looks like I'm close to the front, but Ivan on the outside going to take the first boost into the next. Oh, David playing catch up. Neo, Muhammad, pretty close by. We'll zoom out a little bit. Into the tires we go. All yellow. You guys see all the yellow there. That's the one thing I like about doing this through Twitch is you can use custom balls. Ooh, Smitty. Smitty first one through. It's going to hit that boost. Boom. Smitty going into the tires first. Neo, Fletcher, Crawford. Going to be coming in. Oh, bad bounce. Oh, but he gets hit by Fletcher. Right back in. Neo squeaking his way through. But Gaber and Muhammad and Neo. First three. Looks like Gaber going to be the first one. We got a few more barrels. Tires to go through. Muhammad playing catch up. Hot on his heels. Boom. Oh, Muhammad. Can he find his way through? No, he cannot. Oh, maybe. Oh, he found his way through. Can they play catch up? He's got a bunch of barrels to go through here. There comes David. Boom. Into the tires. Who's going to get through? Who's it going to be? Oh, let's get to the end here. Who's going to come through first? Oh, Midas coming around the corner. Midas, can he sneak through? Midas out of nowhere. Did not mention Midas's name this entire race. And he comes through with the victory. I come through second. David third. Steve fourth. Mike fifth. Ivan, Neo, Smitty, Gaber, and Fletcher rounding out of the final 10. That's how it's done. Midas out of nowhere. And he won by 6 seconds. Look at that. All he had to do is sneak around that last one. I love that one. Run it back. Yeah, that's right. We'll run it back. I want to pick a different one, though. I do really like that one because it has the catch-up potential. Which one was that? It was a Speedway. Yeah, Pixels Raceway. Need to make sure that I remember that. Let's try this one. Hard Landing. Let's clear it. Let's do bots. Make sure no one jumped in here at the end. All right, still just us. That one was awesome. Yeah, that was a good one. All right, so this one, I don't know. We'll see. Follow me to start. Ooh, pretty good. Ooh, we're all gonna be there together. Around and around we go. Who's going down first? Who's going down first? Looks like David over there. I saw David down lower than all of us. Oh, somebody hit. Somebody hit. That's what you want. You want to hit. It'll make you go down quicker. Oh, Ivan. Ooh. Who's it gonna be? Who's it gonna be? You need one good hit and you'll just drop straight down. Oh. It's like those things at the mall. You remember those things with the coins? They would just go around forever and ever. Yeah, Crawford, exactly. That's such a good one. Oh, somebody made it through. You're on Smitty. Smitty out in the lead. I have no idea if you want to go left or right here. but he went left. It looks like he's getting a double zoom pad. The zoomies. There's one. Here comes two. I think he's going to be out to a pretty big lead here. Oh, we got some people coming down the right side, and he's not too far ahead. On to the half pipe. Oh, look at Gaber. Midas and Smitty is now third. Oh, what are these? Oh, they're pegs. Oh, obviously. Oh, can you just go straight through without hitting the pegs? Midas said, I think I can. Didn't get the zoomies. Gaber coming through. Ooh, didn't get that one either. Who's in third? Smitty. Smitty with the zoomies. Oh, but he hits Gaber. They both overtake Midas, though. Are we going to have anyone else coming up? Nope, doesn't look like it. It's a three-way race. It looks like Smitty, Gaber, and Midas. Midas a little off to the right. I think it's going to make it a 2-marble race into the last pegs here. That was pretty cool. I like that one, too. Oh, someone's going to get ejected. Someone's going to get ejected. I feel it. Oh, he just missed. He almost got ejected right into the finish line. Smitty's through. Smitty's through. Oh, I went the wrong way. Smitty is going to be number one. Midas almost a back-to-back. Almost a back-to-back. Oh, Neo. Where's he going? Is he going to land on the course? Nope. That was pretty close, though. Fletcher third in a fourth. Steve fifth. Weren't you fifth last race, too, Steve? Ivan's. Oh, who was that? Muhammad, you landed pretty close. Someone else just got ejected. Who was it? Crawford. Uh-oh, Mike. The fire's coming. Hurry it up. Hurry it up. Ah, you got it. All right. We'll play one more. Hefe, you can still enter. I have it rolling. But it's just for fun. But I can add you as we go. We're going to do one more just for fun as well. Let's do... This orange one's calling my name, but it says it's a fast one. I want to hang around this like 2-minute mark. It seems to be the sweet spot. So this one, the Pixels Raceway, and this blue one, Hard Landing. That was a good one. This one's pretty good too, the Alienated one, because it's got all those spots. I don't think I've ever tried this one, the Lucky Few. Let's see what that one's all about. No, let's do the Alienated one, because this one I know it can pick you up, which is kind of fun. Oh, did you guys hear that? Freaky. Yeah. Yeah, I'm pretty sure at some point you can actually get picked up by the UFO. Little crisscross action. See which way you're going to go. I'm just going to zoom out so we can see the whole track until we get into the cornfield. Decam out to an early lead. Oh, but he's getting sucked up. Everyone's getting sucked up. But you fell right back down. Good job. Oh, I'm in last place by like a lot. I'm going to have some major catching up to do. Inna out in first. Ivan second. Neo third. Midas fourth. Crawford fifth. Oh, you guys got sucked up and out. I almost got sucked up and out too. Here we go. Into the cornfield. Who's going to make it through? Doink. Doink. Oh. No doink. Neo. Midas. Midas finally hitting. Neo just going straight down the middle like a freaking pro. Neo. Like he knew. He's navigated those cornfields before. You could tell. He's navigated them before. Although he did go up that very cleanly. Still doing good. Midas out to a second place coming up now. Just going the opposite way. I'll say this thing rotates as well. So, see, it goes back and forth. So even if you're first, you still got to land properly. Neo clearly out in the lead here. Oh, people are getting sucked up. People were getting sucked up. Hefe made it through. Midas, I think, is gone. Midas got eaten by the aliens. A little probage going on. Neo, I'm assuming, clearly going to reach first, but is it going to be in the right location? Here we go. We're about to find out. Back, forth. It stopped. Is it going to switch? It is. Is he going to overshoot it? No! It moved back and caught him. Neo with the win. Somehow it said I was in third. That can't be right. Inna getting sucked up and probed by the aliens. Here we go. Who's going to finish second? Is it Hefe? It is. It moves for Hefe. Ivan, third. No! It moved back just in time. Smitty for fourth. Is it possible? Oh, Smitty, our first casualty at the end. Steve, fourth or fifth? Not fourth or fifth. In fact, he's off the map. Later, Gator, Fletcher, and David sneaking in there for sixth and seventh. Could I possibly finish in eighth? Where am I? Oh no, the aliens are coming. Muhammad going for eighth place. And he gets it. I could finish top 9. Maybe. Only 10 seconds left. The fire is coming. I overshot it. No. DCAM. I think DCAM's gone. DCAM. See you in another life. That was it. That was it. All right. We're on the My Funded Futures. We're going to take one attempted short position. Assuming we're going to come down and retest the lows. Let's do it. We're gonna bounce off red to green, or are we gonna go through? Let's go through. Go retest those lows. Stop above the fairly obvious area. Although, if we can get through red to green or green to red, I'll move it to break even. I thought for sure we were just going to go, honestly. Here we go. Push it. Push it. Push it. Push it. All right, I'm just going to take it off there. I think that should have went right away. It did not. And now, as you can see, it's trying to bounce. I was hoping it did. I was going to flip over to Apex real quick and get a band trade, but not going to lie, that was part of my hope. Alrighty, guys. I appreciate y'all being here. I will be here tomorrow, same time, same place, as always. Until then, stay safe. Don't do anything silly. Code VOLA for all your prop firm needs. And until tomorrow, peace out. One time. One time. Dude. Dude. Straight. Retest. Please. Go. Just once. Dude. Come on. Come on. Come on. Come on. time, man. Come on. Just shove it. Where's loose? Go. Come on. Do it. Do it. Do it. Come on. Right fucking there, man.